Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Prepared for pain, Jay Powell gives his most hawkish speech yet, saying he is ready to raise rates past neutral to tame inflation. Guilty plea, a unit of Allianz will pay $5.8 billion after misrepresenting the risk posed by a group of hedge funds that collapsed amid pandemic market turmoil. Plus, Jamie Dimon rebuked. A rare blow for the Wall Street Titan as a non-binding vote rejects the JP Morgan CEO's compensation plans.
Yeah, what a blow, Tom. Now let's look at the futures. If you look at the FTSE 100 gaining some, well, 0.1%, the focus, of course, on growth, yet again, the focus on inflation. And then if I could wolf whistle, I would, looking at UK inflation, the highest in 40 years.
I want to hear that, Francine, wolf whistle. Yeah, 9% is what it came in at for the month of April, slightly below the estimates of 9.1%, but nonetheless, as Francine was saying, within the context, the highest level for 40 years, the highest level since Margaret Thatcher was the PM of this country, and I was just 2 years old. So this is dating me, but also more importantly, it points to that conundrum then for the BOE, and of course, amid that cost of living crisis. And what it means for wages is that real wages are less than half now when you factor in what is happening with top-line inflation. We had, of course, the comments from Jay Powell saying he will continue, and they will continue at the FOMC to continue raising rates until he is convinced. There are convincing and sustained signs that inflation is starting to come down. And of course, we also have to factor in what is happening still on the geopolitics. We have the G7 central bank meeting later today. The Eurozone inflation picture will round things out for us. In terms of how things are opening then, the Spanish IBEX gaining 0.3%. The CAC up just 7 points. The FTSE 100 is up just 0.1%. The German DAX is in similar territory. Things in Asia started to turn around. China pairing some of the heavier losses. There's still concern about various other outbreaks across that country, but there's been support for the automakers, and that sector has rallied on the back of potentially additional subsidies. Let's move it on and see how things are playing out then across assets. You did see the Nasdaq closing up almost 3% yesterday. The context were around European stocks, by the way. 3 straight days of gains up until today. We'll see if they can add a fourth day. In terms of the futures then, stateside, losses of 0.3% after, again, a pretty solid day, particularly for the Nasdaq yesterday. The US 2-year, this is where most of the movement has been over the last couple of days, 267. Not a lot of movement in the picture so far today. 267 4-year US 2-year. The euro dollar remains in focus after that commentary that we got from some of the more hawkish ECB officials. Mr. Klaas not yesterday suggesting that you could go higher than a 25 basis point hike in July. Currently 105. You've seen weakness of about 0.3%. Dollar strength today. Brent crude at 112. Currently up 0.4%. Francine.
Yeah, I feel like the market's surfing a little bit. Maybe they're in that holiday mood and they're trying to figure out what they do next. It's very clear, Tom, that when you look at the sectors and we dig a little deeper into them, you have 4 on the downside, but they're not moving by a huge amount. So you have telecoms and basic resources, the biggest losers, between 0.2% lower and 0.4% lower. And then you have utilities, energy, real estate on the way up, but getting some 0.7%. But it's a little bit patchy. I think it's really depending on the kind of forward guidance that some of the companies have done. And so there's no clear direction today. I think we have to see how it settles going into the US Open.
A big story when it comes to the renewable energy space within Europe. Siemens Gamesa, the news that Siemens Energy is planning to buy an all-cash deal. The rest of its remaining shares already holds Siemens Energy 67% of this company. Look at the reaction on the back of that. Gains of more than 8%. We'll continue to watch that story for you. Air France KLM, this is also part of a deal as well that's been proposed. They are wanting to sign up or at least do a deal with CMA-CGM. It's a logistics company. I believe that's the right acronym. We'll double check on that. But the point is that they're going to be creating a carrier service, and as part of that, they'll be selling off about 9% of their stake. Air France gaining on the back of that news, 2.5%. Burberry, concerns about the outlook when it comes to China and COVID-0, of course, such an important market for luxury and, of course, for Burberry. They actually came in at their 4-year sales missing, up 18%. The estimates were for an increase of about 18.7%. Nonetheless, stock is gaining 2.3%. Francine.
Yeah, people must have liked the collection. Jay Powell has said, Tom, that the Fed will not hesitate to raise rates above neutral and warned that it may bring discomfort. Now, we've also been hearing a hawkish tone from some regional Fed presidents.
Inflation is coming down. That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't.
I have been concerned that we need to take aggressive action to keep inflation under control. But right now, I think we have a good plan.
What a lot of economists are scratching their heads and wondering about is if we really have to bring demand down to get inflation in check, is that going to put the economy into recession? And we don't know. At least I'll speak for myself. I don't know.
Let's get to the market impact with our reporter Justina Lee and Hannah Gooch-Peters, global equity investment analyst at Sanlam. So thank you both for joining us. Justina, let's start out with you. What were the key takeaways for you from Powell yesterday?
I mean, those really were some of the most hawkish comments to come from him. And I think the takeaway here is they're really prioritizing the fight against inflation right now, even if it means a little bit of pain, for the economy. And so I think for bond investors, they're maybe wondering, haven't really we priced in enough rate hikes already? I think the answer there is maybe not, unless we do see the CPI, in Powell's language, comes down convincingly.
Hannah, let's bring you in at this point. There's a debate around what neutral is, or is 2.4%, 2.5%, somewhere between 2.5% to 3%. When we get to above neutral, if we get to above neutral, as Jay Powell suggests, is an option for him and the FOMC, what would that mean then for equities?
The equity market's looking for any sense of optimism at the minute, anything positive that they can take away, any sort of desperate attempt, particularly in your sort of longer duration sectors, to try and rebound. And we saw that yesterday. So I think that if we can hit that point in time, I think we may sort of see a sort of a slower rebound. But I think that the problem is we've come from such a high base. We've seen a pullback. And so I think that we'll be in sort of volatile territory from here for the time being.
So Hannah, is a recession now inevitable? And what does that mean for stocks?
I think that it's already starting to get priced in. I think if you, particularly, like I said, if you look in the longer duration sectors, for example, there's a lot of a pullback. But the more cyclical parts of the market are particularly starting to come under pressure from recession. I think that we could see, particularly in sort of your mining sectors, for example, a lot of weakness there where we're actually not exposed. But some other parts of the area, like your sort of industrials, for example, are actually holding up okay, the likes of General Dynamics, for example.
Justina, on the question of fixed income, particularly with bonds, there's a little bit of a move today, 2 basis point move lower for the US 2 year, so at the front end, and again, that's where most of the action has been over the last couple of days. Are we starting to see a bit of a cap to just how high and how fast these yields can rise?
Yeah, it has felt a little bit like this, in the past couple of days, but I think it's hard to conclude that for now because, like I said earlier, I mean, the market has priced in some 50 basis point hikes coming forward in the upcoming meetings. But now Powell is saying, we might push policy rate above what people now consider the neutral rate. And I think to a lot of investors, that is still more hawkish than what they've been hearing so far.
Justina, what does it mean for what you're watching out for in the next couple of weeks? I know we have quite a lot of data. Is it more market reaction or actually fundamentals in the economy?
Yeah, I think what's really important for stocks right now is how, the economy is holding up. I mean, yesterday we did see the S&P 500 cling to its, rebound even after Powell's comments. But, today we've kind of seen risk sour again. And I think that's because, the news out of China haven't been that great. And people really are looking to Beijing to see if we're going to see more decisive policy support. And so far, investors haven't heard that.
Yeah, we've got a couple of announcements around the auto sector, maybe some additional subsidies, but in terms of the concrete action, rhetoric being turned into policy action on the ground, out of Chinese policymakers still waiting for that. Justina Lee, thank you, of course, walking us through some of the key market themes. Staying with us, we're very pleased to say, as Hannah Gooch-Peters, Global Equity Investment Analyst at Sanlam. We'll get more of Hannah's calls after the break. Coming up, guilty. Allianz accepts corporate responsibility in misrepresenting the risk posed by a group of hedge funds that collapsed stateside. We've got more on that story next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Welcome back to the Open. 11 minutes into the European trading day. Some modest gains that you're seeing across European equities, up almost 0.2%. Investors weighing the commentary from Jay Powell, not hesitating. He will not hesitate. The FOMC will not hesitate to raise rates above neutral if indeed that is what is necessary in terms of the assessment on inflation. Francine.
Now, a unit of Allianz has pleaded guilty to fraud and agreed to pay $5.8 billion as part of a settlement with the U.S. Securities and Exchange Commission. That's after misrepresenting the risk posed by a group of hedge funds that collapsed amid pandemic market gyrations. Now, for more, we're joined by Bloomberg's JP Barnard. JP, so first of all, will this have an impact on earnings?
Good morning. Well, I guess not a direct impact. We saw Allianz already about 2 weeks ago making an additional provision when they reported first quarter earnings. And I saw some analysts saying that the fine that they have agreed now with the SEC is mostly reflected in those provisions. So direct impact will not be there. Of course, what is going to be interesting to see is going forward what it means for the company's reputation, what it means for its ability to collect fresh assets. And that, of course, will then have a secondary effect on earnings going forward.
So, JP, is there any more downside? It suggests that possibly there is for Allianz at this point.
Yeah, for sure. I mean, the reputation is a big thing. We need to see how this works out. Also, like what it means for PIMCO and the overall group, if they are still able to pull in assets. We also saw some people being a little bit concerned that the company has to give up it's licensed to advise U.S. mutual funds and some U.S. pension funds. So this is also not very good. The company is in talks with another asset manager to transfer 120 billion over there due to this loss of license. So that will all be, it's not great for Allianz reputation going forward.
So, JP, what does it mean for Allianz Global Investors' reputation, but also assets under management going forward? I mean, this is what you were talking about. Is there a danger that going forward there'll be more outflows because people say, like, look, I'm not sure about this, or do you think they'll forget about it by the time, you know, the fourth quarter comes?
Well, I mean, I guess the market always has a very short memory when it comes to things like that. And if they're able to produce good performance, then I guess people will still go invest with the company. But right now, of course, if you are the decision maker of giving assets to Allianz to manage them, you have to have a very hard due diligence, I guess, to be sure that you're not missing anything. But I have to say, I give Allianz some credit here that they accept responsibility, that they plead guilty. That's a very rare thing to do. Usually financial companies are ducking away, blaming somebody else or some rogue person or whatever. So some kudos for them for this. And I guess this will help certainly with reputation going forward and with investor trust that they say, we take responsibility, it was our fault. We've learned the lessons, and hopefully they have, and not just saying that. And then that could help to ease the burden of explaining to people why they are still a good asset manager.
Okay, Bloomberg's JP Barnett there, getting us up to speed on the latest when it comes to Allianz and, of course, the shenanigans stateside. Thank you, JP. With the
shenanigans.
Shenanigans is maybe a diplomatic way of putting it. Yeah, JP there with the best backdrop in the business. Hannah, let's bring you back in, and I don't expect you to comment directly on Allianz, but in terms of what we draw, the lessons we draw from that saga, because, of course, there was the misrepresentation from the fund managers at Allianz, coupled with the fact that you were at the start of this pandemic, and I just wonder what we draw from that in terms of how alert we have to be now as financial conditions start to tighten, how alert we need to be about potential risks around individual corporates or individual businesses and funds, given what we're seeing in terms of the macro backdrop.
I think for us, the emphasis is always to look on the quality of the underlying companies you're investing in. I think that's so important. That includes looking into your management teams, includes looking into governance, and also very important things like your ability to sustainably grow your earnings and also your balance sheet. So I think if you have a quality mindset as an investor, I think that's always a really, really good place to start with avoiding these upsets.
Hannah, we had this UK inflation jumping to 9%, the highest in actually 4 decades. What does it mean for your appetite on UK assets?
I think that we are exposed to places in the UK like London Stock Exchange Group. So, you know, the provision of data and trading facilities and things, it's not really affected by the inflationary pressures. The fixed income market volatility, of course, is a benefit to a stock like that. Your sort of UK staples, names like Reckitt Benckiser and Unilever, I think they, you know, will have to obviously focus on trying to pass through those input cost inflation pressures for their business. But they're actually holding up very well at the minute if you look at it in comparison to particularly parts of the very high valued sort of sectors over in the US, for example, because their valuations are much more appealing.
And those two names are interesting because they have managed, and we've seen that within the earnings, to pass on the cost. The question is, as the cost of living crisis becomes more acute here, to what extent will households be able to stomach that kind of price rise? You look at Walmart stateside yesterday, they are struggling now to pass on these costs.
Yeah, exactly. And so I think, like you said, I think the emphasis is really going to be on businesses to be able to pass through those input inflation costs. And I think if we think about consumer staples as a whole, they have, of course, held up very well this year. But I think I was looking yesterday, a company like Pepsi, the emphasis on a company like that to be able to sustain putting through those input cost sort of inflation pressures is very large, because they're now trading on a sub 4% free cash flow yield, and for a consumer staple, I mean that's incredibly low. And so I think when you've got no sort of less valuation support and you're a much slower growing business, and I think that your emphasis on being able to pass through these costs and to keep performing is very high. Otherwise, you could get punished by the market.
And in terms of technology, so we just have this breaking news that Nintendo, 5% of a stake is reported to have been bought by Saudi Arabia PIF. What do you do with some of the tech stocks? I mean, Nintendo, I haven't heard of Nintendo, well, actually I do because of the Switch, but that's another thing. You know, some of these stocks that were loved and then now unloved, is this now a buying opportunity?
Yes, certainly for those that are in a quality with a quality mindset. I mean, we're seeing some fantastic opportunities in the software sector, for example. So if you look at companies like Intuit, which is a small business accounting software, TurboTax. I mean, you can see these things have come back sort of over 40% year to date. We're seeing a comeback in the valuation from sort of sub 3% free cash yield to over 4%. It's looking really interesting. Companies like Adobe as well, very much baby thrown out with the bathwater. So the company from its peak valuation point in time back in mid-2020 has pulled back around 25% its share price, but managed to grow its earnings by over 40%. So they're looking much, much more attractive. So, you know, certainly areas of the software market, and we've seen good strength in a company like Electronic Arts this month, which we hold. It's had sort of good news on its results. And so if you look at the gaming sector, actually, it was very much ramped up through the pandemic. It became more depressed. It's given us an opportunity to enter names like that, and Nintendo certainly could be one.
It's remarkable to see names like Amazon and Alphabet down, what, 30 to 40% year to date, and not think that companies like that with those strong fundamentals will be back to a better position in the quarters ahead. When it comes to potentially hedging for the risks that we're seeing globally, does the energy sector still provide that hedge, or have the valuations become less attractive there?
No, I mean, certainly after a 150% move since the market rotated back at the end of 2020, I mean, this is absolutely staggering. But if you look back over a sort of longer time frame period of say, 10 years, this sector is still barely in positive territory in US dollars. So that just shows how depressed it was. And certainly from a valuation basis, it really, really did bounce off its very lows. For us, we choose to stay away from that kind of sector. We don't like capital intensity. We don't like poor balance sheets. And so that's not a part of the market that we will look to invest in. We prefer to sort of diversify our portfolio across a number of other higher quality sectors, such as healthcare, such as information technology and communications, instead of going to those parts of the market.
Hannah, thank you so much for joining us. Hannah Gooch-Peters, especially today, because I know it was a last-minute addition, global equity investment analyst at Sanlam, always smart on some of the investment pieces.
Okay, let's check in on one of the big corporate stories then. We mentioned this near the top, Siemens Gamesa being looked at by Siemens Energy in terms of an all-cash deal. Siemens Energy already owns 67% of this renewable energy company, this turbine maker. It's now looking for an all-cash deal to buy out that company in its entirety. You saw an 11% move to the upside on the back of that announcement. It has now been suspended trading by the regulator. Siemens Energy says it is considering a cash offer to delist Gamesa. So Siemens Energy considering a cash offer to delist this company. Okay, we'll keep across any more lines that cross on that and any other big corporate stories for you. Of course, coming up, JP Morgan shareholders reject a pay proposal for top executives, none other than CEO Jamie Dimon. More on that story next. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Welcome back to the Open. 23 minutes into the European trading day, and within that 23 minutes, the gains that we've seen across the European stocks have become less convincing, just up a tenth of 8%. And in terms of your futures stateside, the S&P E-minis lower by 0.3%, and the Nasdaq futures lower by 0.4 after the Nasdaq posted gains of almost 3% towards the end of the close yesterday. Francine.
Now, JP Morgan shareholders have rejected a pay proposal for top executives, dealing a rare defeat to the chief executive, Jamie Dimon. Just 31% of voters supported the pay packages for Dimon and other company leaders. Well, joining us now is Bloomberg's David Scanlon. David, first of all, why did Dimon's package get rejected, and would he be incandescent about it?
I suspect you might be, Francine. Look, this is unprecedented for the bank. We haven't seen this since 2009 when they first gave investors a chance to have a say on pay, and they spoke pretty loudly and pretty clearly. This really goes back to last year when the board was concerned that Dimon might leave the bank or retire. He is 65 after all. So they sweetened the pot to the tune of about $50 million in options and other compensation, bringing his total pay package to about $84 million. It just didn't sit right, especially in this environment of declining share prices. Look, the bank stock is down 23% this year, one of the worst performing Wall Street bank stocks. So the two advisor firms, Glass Lewis, ISS, both came out and said that investors should reject this pay package, and they did, as you say, to the tune of 70%. So as we say in our story, this is pretty embarrassing for Dimon and for the bank.
An embarrassment for Jamie Dimon and the bank. What is the wider significance beyond this?
There's no immediate effect. These votes are rather symbolic. They don't have any real clout, but it does get the bank thinking, and the bank says they are going to review this. It really is, I think it's more about how they portray this and how they play this in the future. And of course, you can be sure every other Wall Street banking is looking at this very closely, although the contrast just a few weeks ago with Goldman Sachs is pretty stark. You saw David Solomon get a pay bonus of about 30 million, so less than 50, and that one flew through with flying colors, more than 80% support. So maybe 30 is the ceiling here, Tom. I don't know. It's still a lot of money.
Yeah, I mean, some of the conversations behind the scenes, I'm sure, would be pretty explosive. You know, I don't know whether, David, we'll hear about it. They don't usually publicly speak about it, but then Jamie Dimon is known to speak his mind.
They don't. He's a man of many opinions. I mean, typically what the CEOs say in these situations is, well, this is the board's decision. There's a compensation committee decided that. I just accept the paychecks. But I can see where Dimon is pretty proud of himself and proud of his work in his tenure at the bank. And he may well come out and defend this.
Yeah, we'll be watching certainly for any reaction from the CEO, Jamie Dimon, of course, to this rebuke from shareholders. David Scanlon, thank you. Great insights in terms of how that is played out, I should say. Senior editor on our finance team. Coming up, UK inflation surges to its highest level in 40 years, adding pressure for action from the government and, of course, the central bank. That story is next. Your markets across the European space currently just holding on to very slim gains. Future stateside pointing to losses of 3 to 0.4%. Stay with us. This is Bloomberg.
that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. Prepared for pain, Jay Powell gives his most hawkish speech yet, saying he's ready to raise rates past neutral to tame inflation. Spiraling prices while UK inflation rises to its highest level since Margaret Thatcher was Prime Minister 40 years ago. The Eurozone CPI reading for the year to April comes in a couple of hours from now. Plus, Jamie Dimon rebuked a rare blow for the Wall Street titan as a non-binding vote rejects JP Morgan's chief executive's compensation plans. Now, Tom, looking at the markets, I mean, they were down, now they're up, and actually they're getting a nice little lift. I mean, nothing huge, but it seems that this hawkish central bank talk from Jay Powell there seems to be taking their stride.
Yeah, Jay Powell front and center, of course, with those comments around the neutral rate and being prepared to go above and beyond that, whether that's 2.4%, 2.5%, or somewhere in between that level, and 3% is something to be worked out, of course. But that was the most hawkish commentary. That is the assessment, at least from some out there, from the central bank governor, of course, of the Federal Reserve. But also yesterday from Klaas Knot. Yes, he is of the more hawkish contingent, so no major surprise, but interesting nonetheless that he came out and suggested that maybe you need to go above 25 basis points for the ECB come July. Increasingly, officials from the European Central Bank pricing in a rate hike, or at least nodding to a rate hike in July as well. So that layer of hawkishness from the central banks coming through, and then a reminder today in terms of the inflation impact here in the UK, 9%, that is going to continue to lead to pressure on the BOE, possibly to go harder and faster than they already have, of course, 4 hikes from the Central Bank of the United Kingdom. In terms of how the markets are playing out, unchanged now, giving up some of the earlier gains for the benchmark European stocks. You're seeing losses on the DAX just of 3 points. The FTSE 100 is lower by 0.1%. And in terms of your sectors, you do have some gains of about 1%, a little over 1% for utilities, energy, so a move into some of the less risky, more defensive parts of this market. Basic resources is lower. That is the biggest drop there, down 0.7%. You're seeing pressure on iron ore and copper. Housing, by the way, prices out of China falling for 8 straight months. So the concerns around China in the real estate sector, but also, of course, COVID-0. Francine.
Inflation, UK inflation actually rising, Tom, to the highest level since Margaret Thatcher was Prime Minister 40 years ago. Tom likes to remind us he was 2 then, and it's hitting 9% in the year through April. Now, it adds to pressure for action from the government and central bank amid a cost of living crunch and falling real wages. Because I said you were 2 40 years ago, you know, all the youngsters will come up to you and ask you for your press card just to stare at it to make sure, to see how old you are. Now, we are joined to talk about inflation by Sean Raithata, Vanguard Senior European Economist. Sean, thank you so much for joining us. So much to talk about when it comes to inflation. So it's unclear clear whether the Fed is walking into a huge mistake and a recession is unavoidable, and what that means for Europe.
Yeah, it's really the golden question at the moment. Thanks, Francine. I mean, clearly the window for soft landing is really getting narrower and narrower, and particularly in Europe, where the growth risks are much more elevated. And even with the UK now, given high inflation, high energy prices, high food prices, the cost of living crisis will really squeeze that and really increases the risk of recession later this year.
When do you see inflation peaking in the UK? 9%, of course, and that's the headline, the highest level in 40 years, but slightly below the surveys.
Yeah, thanks, Tom. I mean, inflation, although it's bad today, and most of the 2 percentage point increase was driven by energy, it's actually going to get a lot worse, right? So later this year, inflation will probably breach 10% if energy prices stay where they are, because that energy price cap gets reviewed again back in October. But I guess the more interesting part of this report was that services inflation to the levels that you're seeing in the United States, and really raises the bar now for the Bank of England to get inflation back down under control.
Sean, the concern is, if you're in Europe and you're looking at what the ECB will do, can they really raise rates? I mean, the proximity with Russia means that we really don't know what will happen in terms of energy security.
Yeah, and you saw the Dutch governor, right, asking for 50 basis points.
That was bold.
Yesterday, exactly. I mean, I think the window is very narrow here. I feel like they can only really get 1 or 2 rate increases in this year, given that the margin of safety for the growth and recession risk is really elevated. I mean, the economy stagnated in Q1. Germany was the only one that really, of the big 4, expanded, but that came off to contraction in Q4, and Q2 is going to be very bad.
Okay, so just to be clear, you think the markets are getting this wrong, because currently they're pricing in more than 100 basis points for the ECB this year. You think only 2?
I think they're going to have to pause, yes. I think they're going to have, maybe 25, 50 basis points is on the cards. July, I think, is baked in, but further down the line, I think it'll be tough.
Can they do that because the inflation dynamics are so much different in Europe, because you're not seeing those second-round effects?
Exactly. So the big difference in Europe is that inflation is 60% driven by energy and food. That number is close to 40% in the United States and the United Kingdom. And inflation expectations haven't really taken off to the same way. Wages, although it's a lagging indicator, still hasn't come through yet. And so I think there's a bit more room for maneuver for the ECB, and they can afford to be a bit more gradual here going forward.
Sean, so what does that mean if the ECB doesn't actually hike as much as some of the parts of the market is baking in? Are we going to see parity euro-dollar?
Potentially, yes.
I mean that's a huge deal.
We're at 1.05 now, right? And it's come down 7% just year to date. But I guess for the European economy, what the key thing is the trade-weighted index, not just what's happening with the dollar. And in trade-weighted terms, the index hasn't actually done much year to date. And so in terms of importing inflation and that risk, there's not too much there. But of course, the currency is a good mechanism to offset and kind of converge central banks together over time. And if the euro does continue to depreciate, that will import inflationary pressure. And if the stronger dollar means more disinflationary pressure, then central bank convergence might be a theme going into 2023.
Let's stay on currencies then, because the pound, sterling, cable, 124, currently down 0.6%. We saw that move up, that very strong move in pound yesterday. What is the key driver for the pound at this point?
Well, I think ultimately it's going to be coming back to the central bank outlook. I mean, yesterday you had the unemployment data and you had, maybe higher than expected wage growth. Today, maybe a bit more of a paring back of that now. Partly that might be just, profit taking after what happened yesterday. But also, the inflation data, it is starting to move in that direction towards the US. Inflation expectations are rising, services inflation is gathering momentum, and so there is a bit of a balance to be struck there.
Sean, when you look at, if you see a severe downturn, where do you see it first in terms, I don't know whether you look at a specific country, I don't know whether it's consumer spending, like what are the ugly signals in the European economy right now?
Yeah, I think in Europe, what we're seeing in Germany is particularly worrying. You're getting manufacturing orders contracting already. Consumer sentiment is very, very depressed. Normally when consumer sentiment is at these levels, a recession typically follows. But also credit conditions are also tighter. And that's a big deal for, of course, the Eurozone economy, which has a big part to play in the bank lending channel and how that propagates through the economy.
What's the China overlay onto the outlook for Europe?
Yeah, I mean, clearly the European economy has got a high beta to China. It's got a big export sensitivity to China. And clearly the lockdowns have had a big impact on growth here. And that is one of the major risks. And, the economy has been very unlucky with a series of supply-side shocks. China's one of them, but also Ukraine and higher food prices and energy prices coming through that. And that's why there's a real narrow margin of safety. I'm saying it again because it's true, right? And so it only needs one more unlucky shock and we're in recession later this year.
What do you do with the UK? I mean, the UK inflation is so out of control right now. And I know yesterday I said it has one of the worst living crises compared to inflation. I got quite a lot of pushback from people that said, well, this is a political agenda. But what does it mean for how much fiscal spending the government will have to do to try and keep everyone afloat?
Yeah, I think fiscal policy has a real role to play here. I mean, mainly because the Bank of England has their hands tied, right? It's a stagflationary shock. They have to worry about inflation, and so that may become at the expense of growth. Yeah. And so fiscal policy has a role to play in boosting demand and helping with the economy avoiding recession. And from the Bank of England's perspective, they've been very clear, right? If they raise rates in line with market pricing, that will engineer a negative growth in 2023 and engineer potentially an inflation undershoot later in 2024 as well. And so their signal is actually market pricing might be a bit too aggressive. And that's why at Vanguard, we actually think bank rate won't go above 1.5% by the end of the year, and markets are pricing close to 2%.
And for those outside of the UK, one of the key business stories and headlines over the last 24 hours has been the political spat from those within the Conservative Party, the ruling Conservative Party, and the BOE. Is there a concern here about the damage to the reputation of the UK central bank?
Yeah, I'm not sure the Bank of England will worry too much about that. I mean, they're independent and they've got a mandate to get inflation under control. And I think clearly the signals have been that inflation credibility is the main thing that matters here. And they won't be afraid to engineer, a hard landing or potentially a recession in order to get inflation back under control.
Sean. Thank you.
Yeah, great analysis. Thank you very much for coming into the studio. Sean Reitata, Vanguard Senior European Economist on all things ECB, Europe, UK, and of course the Fed as well. Francine.
Now, coming up, don't miss our exclusive conversation with the UniCredit Chief Executive, Andrea Orcel. We hear his views about reassessing the bank's Russia exposure. That's coming up next, and this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Welcome back to the Open. We are 42 minutes into the European trading day. European stocks lower by about 0.1%, pairing some of the earlier gains we saw at the beginning of the session. And you've got a move out of the sovereign debt space, particularly pronounced at the short end. The German 2-year currently up around 5 basis points. We had a line crossing from Olli Rehn of the ECB saying that it is necessary to move quickly from negative rates. We know, of course, Madame Lagarde has suggested that after the asset purchase program ends, and investors are looking at June for that, you could quickly move to rate hikes. We had the comment as well from Klaas Knot, the Dutch member of the European Central Bank, yesterday, suggesting you could be above 25 basis points if the inflationary dynamics in Europe demand that. So just rounding out a slightly more hawkish view from ECB officials, markets now pricing in a July hike from the European Central Bank. Okay, let's check in on some of the individual stocks that are on the move at the open. A couple of deals to enlighten you on. Air France KLM gaining 2.4%. This is on plans to create a cargo alliance with the shipping giant CMA CGM. Air France KLM will sell a 9% stake in the container line as part of that deal. Siemens Gamesa gaining more than 11% on the back of news that Siemens Energy is planning to buy the entire company in an all-cash deal. It already owns about 67%. This is the Spanish wind turbine maker. And Burberry, just up just 0.2%. Full-year sales missing, rising 18%. Estimates had been for 18.7%, flagging concerns around the demand out of China. Francine.
Now, Andrea Orcel is leading UniCredit through a war in Ukraine, rampant inflation, and aggressive central bank tightening. In his first TV interview since taking the helm of the Italian lender, Orcel spoke to us exclusively about his botched hiring in Santander, as well as UniCredit's Russia exposure.
When I look at Russia, separating it, there are two orders of effects that we look at. One is the direct shock from our exposure to Russia. I think that in the last 2 months, we have achieved to reduce it meaningfully by about 2 billion. We've done that. Actually, the team has done a great job without that costing the bank almost anything, which was not to be expected. And at the same time, we have understood very well and in a granular way what the risks are. And we think that in Q1, we took a very conservative set of provisions to try and insulate ourselves the most possible from the further effect from a degeneration of that situation.
The provisions were quite large, and the market took it quite well. Is that how you would describe it?
I think so. I think what we did is, during those 2 months, we were able to articulate in a detailed way what is our extreme loss scenario for Russia, converted in numbers on hit on capital, it's about 130 basis points of capital. And in the first quarter, we took about 195 to be exact.
The question is now what you do with this unit. Are you frustrated that you keep on getting asked over and over what will happen to Russia and the employees there?
Well, I think that anyone who has a large presence in Russia or a significant presence in Russia is being asked. It's normal. I think we believe strongly that let us show you what we execute and let's talk about it then. Because at this point in time, while we have reviewed the situation, we have a number of options that we could pursue. The options are very much affected by the next wave of sanction, by who are the counterparts, what we can do, what we cannot do. And at the same time, we should not forget that we do have 4,000 employees in Russia. We do have 1,500 corporate clients. And what people sometimes forget is that 1,250 are actually Europeans who are trying to go through the same thing that we're going through as a bank, which is deal with the situation in the best way possible.
Well, that was the UniCredit Chief Executive, Andrea Orcel, speaking to us exclusively. It was a 40-minute conversation. You can catch more of that conversation on your Bloomberg terminal online, and then we have the full half an hour tomorrow at 6:30 p.m. UK time. Now let's get straight to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Hi, Francine. Chair Jay Powell says the Fed will keep raising interest rates until it sees clear evidence that inflation is cooling. Powell made his most hawkish remarks yet at a Wall Street Journal event, saying he won't hesitate to push rates past neutral if needed. Powell repeatedly stressed that price stability is the Fed's top priority.
Inflation is coming down. That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't. And honestly, we will go until we feel like we're at a place where we can where we can say, yes, financial conditions are in an appropriate place. We see inflation coming down.
Aid package for India as it looks to deepen security ties and reduce New Delhi's dependence on Russian arms. Bloomberg sources say the package could include weapons financing of as much as $500 million. That would make India one of the largest recipients of U.S. military aid behind Israel and Egypt. The Wall Street Journal reports that black box data for a China Eastern Airlines jet that crashed earlier this year suggests someone in the cockpit intentionally sent the plane into its fatal descent. The Boeing 737-800 jetliner was cruising at high altitude when it suddenly nosedived at high speed into a mountain, killing everyone on board. The UK government plans to introduce legislation within weeks to override parts of the Brexit deal it negotiated with the EU. Foreign Secretary Liz Truss told the House of Commons she'd prefer a negotiated solution, but the situation in Northern Ireland means Britain has to act. The move risks escalating tensions with the bloc. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom Francine.
Okay, Laura Wright, thank you. The Deputy Prime Minister of Ireland on that story, Leo Varadkar, not pulling his punches on how he views the UK right now, saying that it is difficult to know if we can trust the UK government. This is coming from Ireland's Deputy Prime Minister, saying that Irish-UK relations are not good. Boris Johnson, of course, has been in Northern Ireland this week trying to wrestle with this question of the Northern Ireland Protocol and the dispute that is causing with the Power Sharing Assembly, of course, collapsed as a result of that. Francine.
Now, coming up, the future of UK finance. City workers call for more flexible working arrangements after months of pandemic lockdowns. That story's next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 52 minutes into the European trading day, and you can see there's not that much momentum when it comes to stocks struggling. A lot of these stocks in Europe to build, yes, certainly on yesterday's rally, and this comes on the back of some pretty hawkish comments from the Fed, and so suddenly people are once again looking at inflation. But I would say it's a volatile day, Tom, because they were higher, then they were lower, then they were higher again, and now they're down 0.2%.
And volatility is still there. You're certainly seeing that pronounced in the pound today after those strong gains yesterday. About half of those gains now being wiped out in the session today. And the banking sector, by the way, lower by around, 0.4%. Speaking of which, after months of pandemic lockdowns, the City of London is now being tested by an entirely new challenge. Strong demand among employees for flexible working practices. That is according to a YouGov survey commissioned by Bloomberg News. Joining us now is Bloomberg's finance reporter, Tom Metcalf. Tom, what are the key takeaways from this then, and how will they have to adjust?
Yeah, I think for me it's this disconnect between what we've been hearing from corner offices, so of course like, Goldman's CEO, JP Morgan's, Diamond, and actually what this survey showed, which is basically said about 500 executives more in the middle ranks, and they are all saying, look, we have no interest in coming back to the office anything like 5 days a week. So it's more like 2 days a week, even less. I think it was something like only 14% of respondents.
Less than 2 days a week?
Yeah, 2 days a week or less.
Okay.
So not even the Tuesday, Wednesday, Thursday.
There's a real stickiness to this.
Yeah, and I think we can see it as we walk around the neighbourhoods, right? Like, obviously Monday and Friday is very quiet, but City of London's not back to what it was. So.
Monday and Friday you can get a taxi. Wednesday, Thursday, you absolutely can't get near a black cab or anything like that. Are banks adapting? Does it actually make a difference if you have the flexible working?
So it's a really interesting time, right? Because as we know, there's a big sort of battle for talent at the moment. So what we've seen in terms of how banks have adapted, I think there's sort of an uneasy truce. So there is this Tuesday, Wednesday, Thursday push. Even JP Morgan has said, you know what, we will sort of accommodate hybrid working to some extent. But there's obviously a limit to what, say, Goldman Sachs can do. It needs its traders on the floor. So instead, what we're also seeing is, maybe the tried and trusted formula of higher pay. We saw what Goldman did with sort of unlimited vacation and boosting holiday allowance for junior staff as well. But I think it's just a tough situation. The corner offices want people back, and the workers are saying no. How do you meet those two?
Is there a big difference between how this is unfolding in London versus New York versus Singapore?
I think that's probably going to be the biggest worry for, say, the City of London. Is you look at Paris, you look at New York, and they are closer to pre-pandemic norms by sort of 10-15% than London is. So that would be the concern. Is if all the financial centres are going through this, that's easier to sort of compete with. But if, say, New York is like, hey, we're back to normal, why wouldn't you go to New York?
Tom, when you look at some of, who are the kind of workers in banks that want to not come back into the office? Is there like age bracket, or is it almost impossible to tell?
So from the survey itself, it's pretty tricky to say, but from what we've been hearing, it's the sort of middle part, which is most sort of resistant. So the senior folk, the older folk, definitely keen. Junior folk are also for sort of learning opportunities. And what actually the Lord Mayor told me is he expects there sort of almost be a squeeze on folk in the middle who, might eventually feel obliged to come back in because their bosses are in, their juniors are in, so they sort of feel that they also need to come in. So that could be what shifts over the next couple of years.
Do we know any more about productivity, working from home productivity, and what the views are on that?
I think it depends who you ask, right? But, I don't think there's been, a huge drop-off, but increasing data showing that, being in the office is that little bit more effective. Of course, it's where the sort of balance comes in, right? Is it effective enough to take away the cost of a commute? And I think some people will say no.
There you go. Some people say no. We say yes. Tom, thank you so much. Tom Metcalf there. We're always in the studio with Tom Metcalf. Now, that's it for the European Market Open Surveillance Early Edition is up next. And markets, Tom, are seeing a bit of a wobble today.
Yeah, they're turning around now, down 0.2%. The future stateside as well, looking to losses on the S&P E-minis of 0.4%. The Nasdaq futures looking lower by 0.6 after posting gains of almost 3%. Jay Powell coming out and saying he would not be afraid of going above neutral if it means tackling inflation, continuing to push rates higher until he sees inflation coming down at a convincing rate. Plenty more coming up. This is Bloomberg.
worries about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Inflation is unacceptably high. We need to do everything we can to bring it down. It was heartening to see headline inflation tick down modestly last month, but obviously we've got a ways more to go.
Inflation is biting. We see for low-income or lower-income families really difficult to deal with the rising cost of energy.
I think we're going to have a second big bite at this apple, a recession that's more traditional in sense, where the Fed can't bail out the recession because they're still tightening to control inflation.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Prepared for pain, Jay Powell gives his most hawkish speech yet, saying he's ready to raise rates past neutral to tame inflation. UK inflation, in fact, rises to its highest level in 40 years, adding to pressure for action from the government and the BOE. We get data from the Eurozone a little bit later today. Plus, Jamie Dimon rebuked a rare blow for the Wall Street titan as a non-binding vote rejects the JP Morgan's chief executive's compensation plan. Now, first thing is first, because we have a plethora of story that we need to get through, but this is what the market's looking at. We started the note on the high. Now we're seeing a bit of pressure down some 0.2%. Again, when you look at what markets are thinking at, well, I guess some of the stocks are actually falling. They did not build on the rally we saw yesterday. We did have, of course, those hawkish comments from the Federal Reserve Chair, but also the latest data on inflation and economic activity. It's what traders will probably latch onto. The FTSE flat, the dollar index, and I had a couple of calls, so it's good to look at the Bloomberg US dollar index, but also could we be looking at parity between euro and dollar? That's probably one of the biggest questions we need to ask ourselves in the next couple of weeks, and this is especially if the ECB can always raise rates to the point where markets are pricing in, and you can see pound or cable at 123.96. Now, in terms of the difference between, for example, Germany, and we're seeing factory orders and we're seeing the German economy, if we get the European map up for you, when you look at this economy, which is Germany, it will have, of course, a huge impact on everything that's going on in Russia. It's probably the economy that will suffer the most because of the reliance on energy, because of the proximity to Russia. In today's trading session, you can see the FTSE MIB and the FTSE here in the UK unchanged, the CAC down 0.1%, similar to the DAX. But you're seeing, I don't know if it's volatility, but certainly they haven't really made up their mind of whether they're focusing on the positives or the negatives. Now, Jay Powell has said the Fed will not hesitate to raise rates above neutral and warn that it may bring discomfort. We've also been hearing a hawkish tone from some regional Fed presidents.
Inflation is coming down. That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't.
I have been concerned that we need to take aggressive action to keep inflation under control. But right now, I think we have a good plan.
What a lot of economists are scratching their heads and wondering about is if we really have to bring demand down to get inflation in check, is that going to put the economy into recession? And we don't know. At least I'll speak for myself. I don't know.
Well, joining us now is Bloomberg's managing editor for EMEA markets coverage, Lynn Thomason. Lynn, when you look at some of this inflation debate and how the market is positioned, what's the next step for where markets get their cue on?
Yeah, I think everything is so keying on the inflation data. And the really interesting thing is that hot number from the UK this morning really shows that it's just continuing to get worse and worse. And where you're seeing the US and EU expectations are for inflation to soften, the UK looking like it's in a really difficult spot.
And so what does that mean so when you look at markets and actually how equities are performing, is worse, or actually is recession already priced in, or do you think it has a lot more to fall?
That's such a good question. I mean, global stock market's already down, to the tune of 16% this year. So it sure seems like people are, at least getting ready for that recession. Big question will be, how bad does the recession look? I mean, if it really is a stagflation situation, I think a lot of people would say we're not pricing in that scenario. If anything, we're, looking like a sort of a mild recession at the moment.
So, Lynn, what's risk appetite like? And I know it changes every day, and sometimes it changes even though the facts don't really change.
Yeah, I mean, the interesting thing last week was you had that incredibly severe sell-off, and then the mood has softened this week. Markets are mixed, things are starting to stabilize. I mean, what's really interesting is that for all the, terror in the crypto world last week, things are stabilizing, and Bitcoin is really holding at that 30,000 level, which shows that, perhaps people are finding some reason to stick to that.
Lynn, when you look at the dollar, I mean, it's ever higher. I don't know if there's anything to stop that rally.
Yeah, I mean, we had a great story today about, speculation that there might be some kind of coordinated intervention to bring down the dollar. I mean, obviously, very speculative. Who knows what's going to happen? But even the fact that that's starting to be talked about in the market just goes to show how worried traders are about the strength of the dollar and what that means for economies and, the purchasing power of people around the world.
I mean, this changes everything, right? There's almost no sector that's immune to a rising dollar.
Yeah, absolutely. It'll play into companies' balance sheets. Obviously, companies that import or, sort of get their sales in dollar will be doing well, and you might start to see that differentiation in the stock market. But I think there's a lot of concern that the dollar strength is just going to be disorderly, and you rarely do you see such strong moves happen so quickly.
Lynn, anything else you're looking for? I mean, I know it's inflation. We're looking at the specter of recession. We're not looking at earnings anymore, and then we're seeing it seems to be playing out on currency markets, really.
Yeah, absolutely. I mean, for the longest time we thought currency volatility was dead, and now it has come back with a vengeance. Yes. I mean, the stock market is usually where you go to see volatility, but now it's in currencies, and really the dollar is such a dominant force around the world.
Yeah, and I have to say, when currencies are volatile, they don't kid around. So thank you so much, Lynn Thomason, there, joining us with the latest on the markets. Now, coming up, our exclusive conversation with Andrea Orcel, the Chief Executive of UniCredit. We talk Europe's inflation situation. That's coming up shortly, and this is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When I look at Russia, separating it, there are two orders of effects that we look at. One is the direct shock from our exposure to Russia. I think that in the last 2 months, we have achieved to reduce it meaningfully by about $2 billion. We've done that. Actually, the team has done a great job without that costing the bank almost anything, which was not to be expected. And at the same time, we have understood very well and in a granular way what the risks are. And we think that in Q1, we took a very conservative set of provisions to try and insulate ourselves the most possible from the further effect from a degeneration of that situation.
The provisions were quite large, and the market took it quite well. Is that how you would describe it?
I think so. I think what we did is, during those 2 months, we were able to articulate in a detailed way what is our extreme loss scenario for Russia, converted in numbers on hit on capital, it's about 130 basis points of capital. And in the first quarter, we took about 195 to be exact.
The question is now what you do with this unit. Are you frustrated that you keep on getting asked over and over what will happen to Russia and the employees there?
Well, I think that anyone who has a large presence in Russia or a significant presence in Russia is being asked. It's normal. I think we believe strongly that let us show you what we execute, and let's talk about it then. Because at this point in time, while we have reviewed the situation, we have a number of options that we could pursue. The options are very much affected by the next wave of sanction, by who are the counterparts, what we can do, what we cannot do. And at the same time, we should not forget that we do have 4,000 employees in Russia. We do have 1,500 corporate clients. And what people sometimes forget is that 1,250 are actually Europeans who are trying to go through the same thing that we're going through as a bank, which is deal with the situation in the best way possible.
Well, the Unicredit Chief Executive, Andrea Orcel, they're speaking to me. You can catch more of that exclusive interview on your Bloomberg terminal. It's about 40 minutes. And then you can also catch it on TV tomorrow, 6:30 p.m. UK time for the full 30-minute program. Now let's get the latest on the Twitter takeover. In spite of Elon Musk's ad hoc tweets and conference statements creating noise and uncertainty around his bid to take the company private, behind-the-scenes advisors are working to seal the transaction. Well, for more, we're joined by Bloomberg's Laura Wright. So, Laura, what do we know? Is he going to buy it? Does he want to buy it? Does he want to buy it cheaper, or is he just going to walk out?
Well, yesterday, Twitter released a statement to Bloomberg News that said, "We intend to close the transaction." Twitter trading negatively in the pre-market, although yesterday the social media platform was able to snap 7 straight sessions of losses. So we learned from an SEC filing yesterday that Elon Musk waived his rights to due diligence so that it could expedite his bid before an arbitrary April the 20th deadline. We know there's a $1 billion exit fee for either party that walks away. There is also a specific performance clause, which means so long as Elon Musk has the financing in place, he is obligated to go ahead with the offer, unless he can prove something has materially changed. And that is what Elon Musk is trying to do by rallying support, challenging Twitter's statement that less than 5% of their users are false accounts. Just last night, he posted a Twitter poll on this. It currently has around 1.5 million votes. But Francine, it's a lot of chaos, a lot of confusion. Which way Elon Musk wants to take this?
Yeah, I mean, certainly he's like a one-man band, driving this. What do we know regarding SpaceX financing rumors?
Well, coincidentally or strategically, you might argue, there are reports that SpaceX will be going ahead with a new funding round that should value the satellite company at close to $125 billion. That means SpaceX will be the most valuable U.S. startup on record. Employees will be able to offer their shares at close to $70 in a tender. It's unclear yet whether Elon Musk will partake in such a sale. One of the reasons why he might do this is so it can eradicate a $6.25 billion margin loan, which is still tied to his Tesla shares and has been rather contentious. Although that said, eyes are now focused on this $13 billion debt tied to the social media platform, because as part of the deal, that means there'll be annual interest payments of around $1 billion. While Elon Musk hasn't outlined just how he's going to diversify Twitter's revenue strategy, for analysts, that's looking like a bit of a financial headache.
Yeah, it certainly is. Thank you so much. Bloomberg's Laura Wright with the very latest on Twitter. Now, coming up, the U.S. overtook China as the top destination for Swiss watch exports in 2021. We'll be joined by the chief executive of Watches of Switzerland, Brian Duffy, to discuss earnings results and growth in the U.S. market. That's coming up next, and this is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Daybreak with Lee. On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gehrens. Hi, Leanne.
Hi, Francine. UK inflation has risen to its highest level since Margaret Thatcher was Prime Minister more than 40 years ago. Consumer prices surged 9% in the year to April, the fastest rate since 1982, and more than double the pace of basic wage growth. The Bank of England is predicting double-digit inflation by October, when energy bills are likely to jump again. Now, Chair Jay Powell says the Fed will keep raising interest rates until it sees clear evidence that inflation is actually cooling. Powell made his most hawkish remarks yet at a Wall Street Journal event, saying he won't hesitate to push rates past neutral if needed. Powell repeatedly stressed that price stability is the Fed's top priority.
Inflation is coming down. That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't. And honestly, we will go until we feel like we're at a place where we can say, yes, financial conditions are in an appropriate place. We see inflation coming down.
Now, the U.S. is preparing a military aid package for India that looks to deepen security ties and reduce New Delhi's dependence on Russian arms. Bloomberg sources say the package could include weapons financing of as much as $500 million. That would make India one of the largest recipients of U.S. military aid, behind both Israel and Egypt. And the Wall Street Journal is reporting that black box data from a China Eastern Airlines jet that crashed earlier this year suggests someone in the cockpit intentionally sent the plane into its fatal descent. The Boeing 737-800 jetliner was cruising at high altitude when it suddenly nosedived at high speed into a mountain, killing everybody on board. JP Morgan shareholders have rejected a pay proposal for the top executive, dealing a rare blow to CEO Jamie Dimon. Just 31% of voters supported the package for Dimon and other company leaders. Shareholders, advisors, Glass Lewis were among those criticizing a $53 million option award for Dimon. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gehrens. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Watches of Switzerland saw revenue growth of 48% in its fourth quarter earnings, with continued super high demand for brands such as Rolex and Patek Philippe. Now, the UK-listed company has been expanding aggressively in the US, now the most lucrative market for luxury watchmakers and sellers. Well, we're joined now by the Chief Executive, Brian Duffy. Brian, thank you so much for joining. I remember actually our first interview, which was, I think, the day you listed. And that feels like yesterday,
yeah, 3 years ago.
Pre-pandemic.
Yep.
Talk to me a little bit, first of all, how you've lived through the pandemic. So there's no travel. I guess, I don't know whether people bought watches online or whether that was just too difficult.
Yeah, I mean, a variety of things. There was a big increase online. We doubled our business online. Our US business had less of a lockdown than the UK. UK, we were able to do click and collect. We really used our systems. We get great CRM systems. We get great technology all around. So we were able to keep a reasonable business going. So even in the first year, we still had growth, 5%, despite the lockdown, despite the fact there was no tourists, despite the fact there was nobody in the airport. Next year, 11%, and then this year, 40%. So we've done okay.
Brian, given where we are now, almost to June 2022, what surprised you the most about the business? Is it the resilience? Is it the fact that now you have more, appetite for your products in the US and elsewhere?
Yeah, it's not a complete surprise to us. I mean, our view has always been the market's underdeveloped. The UK is the best luxury watch market in the world, but even here, I think we're proving that it's underdeveloped. And the US, for sure, was underdeveloped. So we already were enjoying a really good experience in the US from investing, bringing our formula for beautiful big stores and luxury client service. I think, during the COVID period, did this category get a bigger share of wallet because people couldn't travel and so on, perhaps. So perhaps there was an element of acceleration. And what surprises me continually is just how innovative and energetic and enthusiastic our people are.
Do you miss Chinese tourists, of course, in destinations where you have shops?
You know, it was never a big deal for us. I mean, it was 7% of our group beforehand was Chinese tourists. The airport was a bigger loss overall for us, just people travelling through the airport. So fiscal year 19, pre-COVID, 33% of our business was international airport or combined tourism. The last year it was 3%, so we had to overcome a deficit of 30, you know, before growing. But, you know, we love our watches here and in the US, and there's more demand than we can supply.
Is there more demand so people don't go for the new cool ones that give you how many steps you do and things like that?
You mean ones like this one, the Tag Connected? People do. You know, obviously people are wearing Apple Watches around the world, but there's been no impact in the world of luxury watches.
What are you wearing? This is a fancy...
This is a Tag Heuer Connected watch. The LVMH group have done a lot with technology on Connected. This does tell me my steps.
Do you sell more of those as opposed to like the old school ones?
No.
Do you think you will in the future?
No. I mean, old school, as you call them, you know, traditional, mechanical, artisanal. There's a huge demand for mechanical watches, and as I said, one that we're nowhere near to supplying. I think this is nice new technology, and in this case, it's put in a beautiful case, you know, with a nice strap, and it's a reasonably expensive watch. You're still looking at £2,000. So I mean, it's all positive.
So what does it do? I feel like, I mean, it's lighting up. You're talking, it's lighting up.
But it's doing pretty much
prices.
everything an Apple Watch would do. It's telling me my steps. That is why I have it. You know, it was never practical to personally count.
You can wave Italian hands like I do, and you get steps without actually moving.
Oh yeah,
right?
Okay, you're cheating. But you know what? I play guitar, and I have to take it off because I get step credit for playing guitar. Yeah.
Brian, talking about inflation, are you able to? I mean, I imagine that your customers are not inflation sensitive. So you can hike prices by even 30% without hurting demand?
But that's not happening. I mean, I think the industry has been very considerate. The average price increase this year will be around between 4 and 5%. And commodity prices have definitely increased more than that. The Swiss franc has appreciated, particularly against the pound. So I think the industry has been quite thoughtful and not pushing pricing overall.
But why not when you see, you know, companies such as Chanel going up 25%?
Yeah, I mean, we don't determine the pricing. It's determined by Rolex and Swatch Group and Richemont and so on. And as I say, I think they've been considerate in you know, what's happening in the world. But whatever, the average increase is around 4 or 5% for the year.
So what's, you know, happening with you in the next 12 months? Is there expansion plans? Is there anything exciting that secret that you can tell us about?
Well, a formula I think is proven. We have a great model. We proved it in the UK. We've now proven it in the US. We did a long-range plan saying we'd increase our US business between 25 and 30% annually. Obviously, we're ahead of that this year, quite comfortably with a 48% increase this year.
Yeah.
We're entering the European market. We have a lot ahead of us.
Brian, thank you so much. Brian Duffy there, the Chief Executive of Watches of Switzerland. Coming up, a conversation with Mohammed El-Erian. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior Airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Prepared for pain, Jay Powell gives his most hawkish speech yet, saying he's ready to raise rates past neutral to tame inflation. UK inflation rises to its highest level in 40 years, adding to pressure for action from the government and the BOE. We get data from the Eurozone later today. Plus, Jamie Dimon rebuked a rare blow for the Wall Street titan, and his non-binding vote rejects JP Morgan chief executive's compensation plan. Well, good morning and welcome to Bloomberg Surveillance Early Edition, everyone. I'm Francine Lacqua here in London. Now, this is what the markets are telling us. There was a bit of volatility across the board. We started the day higher. Now we're seeing a bit more pressure. The European stocks, 600 down 0.1%. So some of these stocks are stalling. Certainly, they're not building on yesterday's rally as traders assessing those hawkish comments from the Federal Reserve Chair, but also the latest data on inflation and economic activity. Now, Andrea Orcel is leading UniCredit through a war in Ukraine, rampant inflation and aggressive central bank tightening. In his first TV interview since taking the helm of the Italian lender, Orcel spoke to us exclusively about his botched hiring at Santander, as well as UniCredit's Russia exposure.
I will always be sorry for how it went. This is another bank I admire a lot, and that hasn't changed. I think for me, it was more about confirming the facts, confirming the truths that I knew existed, and that has been done, and it's uncontroversial. I mean, you will find it black over white through the process that has happened. That, for me, was very important because a number of stories were written at the time. What happens then, I mean, obviously Santander has appealed, we'll see, but for me, the important point was that the truth is there, the facts are there, and at least mentally, I have moved on.
I mean, your case is probably studied in universities, because people want to know how they're paid. You know, I think 68 million without never starting a job, but also to try and understand what labor laws and everything like that works. Do you think it's changed the way we look at banking laws and banking?
I don't know if it has changed. What I know is that we shouldn't forget that banking is a highly regulated industry. As a result of that, senior jobs have a very large component of deferral in their compensation. In the UK, it's 7 years. And more than 50%, if not 60% in certain cases, of your compensation is deferred over 7 years. If you do the math, that means that at every point in time, you're going to have between 3-4x of your compensation deferred. And that is indexed to the share price of the bank where you are. And if it goes up, those 3-4x becomes even more. The difficulty is when you change organizations, what do? You either have the new organization that assumes that deferral, or you don't move. Because in effect, that deferral is your entire savings. So I do think that although these are large numbers, they need to be put in context of how they got there. Usually, in most cases, in all cases, the organization who hires assumes that liability or deferral. So that number is that liability and deferral, is plus a few other things that occurred because of the case, but that is what it is.
Was it an emotional roller coaster? Is it something that you've put behind, or is something that you don't think about?
Well, at the beginning, it was obviously an emotional roller coaster. I think from a family standpoint, it was quite impactful, and I think personally, given the esteem I had for that bank, it was quite impactful. I think the important point was once I went through the preparation of the case, I detached and I left other people deal with it, and I was quite fortunate that those people were excellent. And then I trusted the process. A lot of people told me not to trust the process, but I did, and it ended up being worthwhile.
That was the UniCredit Chief Executive, Hunter Howard-Charles, speaking to us exclusively, and you can watch more of that conversation on your Bloomberg terminal and online. Now, we're also getting some earnings from Tencent. First quarter revenue just shy of estimates at 135 billion yuan. I think the figures we had speaking to analysts was 141 expected. Now, let's get back to banking. JP Morgan shareholders have rejected a pay proposal for top executives, dealing a rare defeat to the chief executive, Jamie Dimon. Just 31% of voters support the pay packages for Dimon and other company leaders. Now, joining us next is Bloomberg's finance editor, Michael Moore. Michael, thank you so much for joining us. First of all, I mean, I can't see Jamie Dimon taking this very well, but why was the pay rejected?
Well, I think a lot of it was had to do with the special awards that were awarded last summer. That was supposed to incentivize Dimon to stick around several more years, as he, has been in place for a long time. So I think that was kind of the main piece, and then also, the pay has steadily risen. So I think this is, shareholders sending message, but obviously it's non-binding proposal, so the bank doesn't have to walk it back. But you tend to see banks make some adjustment, at least in future years, to take this on board when they do get this kind of rejection.
So what's the wider significance of this?
I mean, it's pretty rare. You had Citigroup a decade ago have this happen, and it became a major issue for them. They had to address it in future years. But so it, these say on pay proposals only came in after the crisis. Typically, you see 80+% in favor. So I think this is pretty rare. It may. You may see the bank try to make more of it tied to specific performance metrics. Banks have been moving in that direction generally. But, because the bank has done quite well, Jamie's awards have grown over the years. Even the ones he was given at the time ended up being worth a lot more than the stated value at the start. So I think as long as the bank continues to perform this well, it won't be as big an issue.
Mike, the other big story is, of course, the big change at Societe Generale after the chief executive said he'll step down next year. Yeah,
he's the longest-serving European bank head.
15 years? Or 13?
Yeah, it will be 15 by the time he steps down next year. He's went from everything from financial crisis then to, the crisis in Russia and Ukraine now. So he's seen quite a bit in what has been a very turbulent period for his bank and European banks in general.
All right, Michael, thank you so much. Michael Moore there, who heads our finance coverage in Europe. Now, coming up, we speak to the Bloomberg opinion contributor, the one and only Allianz Chief Economic Advisor on the Fed stagflation, the outlook for the U.S. economy. He's one Mohammed El-Arian. If you have any questions for him, send them to IB plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Jay Powell said that the Fed will not hesitate to raise rates above neutral. In an event hosted by the Wall Street Journal, he called price stability the bedrock of the economy and vowed to push until inflation falls.
If the economy performs about as we expect, then that's something that'll be on the table. And honestly, things are so uncertain in the economy right now, it's very difficult to think about trying to give guidance out into the future.
Well, we're now joined by Mohamed El-Erian, Allianz Chief Economic Advisor, President of Queen's College Cambridge, and Bloomberg opinion columnist. Mohamed, great pleasure and honor actually to have you in the studio in London. You've been banging the drum about the Fed being too late. Is a recession at this point now unavoidable in the U.S.?
It is not unavoidable, but unfortunately the probability is going up. What is unavoidable is stagflation. And we're seeing growth coming down, and we're seeing inflation remaining high. And the Fed is finally catching up to developments on the ground, but it still has some way to go.
Okay, so if you look at stagflation, what does that mean for stocks? How much of it is already priced in, or how much more volatility will we get?
So we've gone sequentially through pricing in inflation risk and interest rate risk to pricing in tighter liquidity. What we haven't priced in yet is a significant slowdown in growth. So we are mostly through the adjustment, but not quite there yet. I think there's probably another leg to come.
What does this mean for the U.S. consumer? Are they strong enough to withstand this for a couple of quarters?
So the consumer in general they still have significant savings that were built up during the pandemic with all the transfers from the fiscal side. But the issue, Francine, is distribution. There are very vulnerable segments of the population, and so far we haven't seen enough being done to protect them.
Now, stagflation is also, I guess, every central bank's worst nightmare. When you look at the situation in Japan, I mean, they were stuck in this for a long time. Is the U.S. or the world becoming more like Japan, or is it a stagflation, a transitory stagflation environment?
So that is really hard to project at this time. Stagflation is the worst thing for central banks, especially for the Fed, because it puts its two objectives in conflict with each other. And that's why a lot of us wanted to avoid the situation. And this situation was avoidable. That's what sort of upsets a lot of us. It was avoidable had the Fed not stuck to its transitory inflation characterization. Now that we're here, it is very hard to find a first best policy outcome. So the Fed is going to have to make a very difficult choice. A lot of people say it needs luck and skill. Yeah. Well, it needs a lot of luck at this point.
So what would you do if you're in charge of the Fed right now?
So what I would do is I would first and foremost explain why I got the inflation call right, because I need to restore my credibility on inflation. I would explain how I am better as a Fed in forecasting inflation, and I would take actually the approach of Andrew Bailey at the Bank of England. I would be brutally honest. Technocrats should be brutally honest, and I think Andrew Bailey is showing the example to other central bankers of what does it mean to be a technocrat.
Yeah, but it doesn't make the job any easier if you're in this kind of environment. So does the Fed need to go 75 basis points? Where do you see the terminal rate, for example?
So all this discussion of the neutral rate forgets that ex ante, we don't know what the neutral rate is.
Fair.
So they're going to have to go and get a sense, and they better go early than late. Already we are late in reacting. So they're going to have to judge as they go along, but they're going to have to start. If it were up to me, I would start with 75 basis points. I wouldn't start with 50. I would give a very clear signal that I'm serious about this, and I would try to contain inflation expectations from now.
But they took it off the table, and I don't know whether that was to guide the markets. Are they concerned about market reaction? Like, what exactly is this dynamic?
So I think Chair Powell took it off the table.
Yeah.
He was then pressured by the market immediately. He was then criticized by many people saying, how could you take it off the table? If you say the economy is so uncertain, how could you take... And if you've noticed, he walked it back. And yesterday, he took one step further back in walking it back and saying, you know what, I will be open. And he's also taken back the notion that he knows what the neutral rate is. He's now willing to say, I may have to go beyond the neutral rate. So he is evolving because of the reaction to when he tried to be too specific in a very uncertain environment.
When you look, of course, at this reaction function between markets and the Fed, at what low point in the S&P does the Fed put start to kick in?
So I don't think it kicks in for a while. It kicked in the past because inflation wasn't a problem, right? Ben Bernanke had an interview, and he said the reason why the Fed didn't move earlier was because of concerns for the markets. Yeah. Well, now it is inflation. So I think those who think that the Fed put this anywhere in the money will be sorely disappointed. It's quite out of the money right now.
So is the dollar rally then unstoppable? I know that there's also chatter about intervention. I mean, things that we haven't heard, frankly, for almost a decade.
Yes, I mean, Bloomberg is running a story today that the unthinkable of another Plaza Accord is now being talked about. I think that remains unthinkable. I think right now, the environment, the international environment doesn't allow for a currency accord. Having said that, the strengthening dollar raises the specter of what I call little fires everywhere. Because if you're in a developing country right now, the last thing you need is a disorderly depreciation of your currency against the dollar at a time when energy prices are higher, food prices are higher, and the global economy is slowing down.
Okay, little fires. The problem is that if we have one big one, that all matches up. So we'll talk about that next. Mohamed El-Erian there stays with us. Now, let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Francine. A unit of Allianz has pleaded guilty to fraud and has agreed to pay $5.8 billion after misrepresenting the risk posed by a group of hedge funds that collapsed during the pandemic. The deal closes an embarrassing episode from the German insurance giant, which has also agreed to sell the bulk of Allianz Global Investors US as part of a settlement with the SEC. Walmart shares have tumbled the most in almost 35 years after it cut its full-year profit forecast due to inflationary pressures, especially in both food and fuel. The world's largest retailer set the stage for more price increases, saying it would seek to balance customers' needs with the goal of delivering profit growth. SocGen CEO Frédéric Oudéa says he will leave the bank next year after nearly 15 years. The longest-serving CEO of a big European lender has told shareholders of his surprise decision not to seek reappointment during the company's AGM. SocGen says it will select a new CEO by next year. And Saudi Aramco is said to be considering an IPO for its trading arm in what could be one of the world's biggest listings this year. Bloomberg has learned the state-controlled oil giant is working with banks including Goldman Sachs, JP Morgan and Morgan Stanley as it studies a potential listing. The business could be worth as much as $30 billion. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Coming up, Allianz Chief Economic Advisor and Bloomberg opinion columnist Mohamed El-Erian on that hot UK inflation reading. We'll talk sterling. We'll also talk a little bit of ECB. That and much more next. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now we're back with Mohamed El-Erian, Allianz Chief Economic Advisor, also Bloomberg Opinion Writer. And I have to say, everybody should subscribe to Mohamed's columns because they're great, they're brilliant, and sometimes they're also very funny. Mohamed, thank you so much for staying with us. We were talking, about what the Fed's mistakes have been, and you were saying, look, they just have to be much more honest, like Andrew Bailey. So we'll talk about the Bank of England in a second. But talking about this idea that actually what we're creating with the dollar rally is fires, right, across the globe. Is there a worry that these fires suddenly join up and actually the forest, the whole forest is on fire?
Yes, there is. I mean, right now we're focusing on the big fire, which is, of course, the Ukraine war.
Yeah.
But that big fire has triggered small fires because of what it's done to food and energy prices. Add that to the dollar appreciation, and we are going to see, unfortunately, quite a few commodity imported developing countries coming under pressure. What does that mean? Lower growth.
Yeah.
It means debt restructurings.
Yeah.
And it also means, unfortunately, socio-political instability.
Does it mean defaults?
So I do think you're going to get restructurings. Whether it means outright defaults will depend on the international organizations. There's a lot of work being done by the IMF and the World Bank to give air cover to orderly restructurings, and it's in everybody's interest to have orderly restructurings. But I suspect that we will see a lot of original contracts being modified.
Could there be something big enough that actually puts the whole financial system at risk? I mean, if we're able to freeze out the 11th biggest economy in the world, Russia, and suffer consequences, but more linked to the gas and oil, does it tell you about the resilience of the world economy, or is it something else?
So it's certainly resilient, but we are running down our resilience tank. Don't forget that we ran quite a bit of it down in COVID. So, for example, we cannot respond on monetary policy like we responded during COVID. We cannot respond on fiscal. So we are running it down. We still are very resilient. I worry less about the advanced economies than I do about developing countries. And I think the comment in particular by the IMF Managing Director, Christina Georgieva, which you know very well, which is we could be talking about a cost of living crisis in the advanced world, but we risk a famine in the developing world. I mean, that is the difference right now.
So again, what does that mean? I mean, is there any organization that can step up? Because what you say is very true, and it's largely ignored by a lot of big economists.
It is. I mean, a lot of people were hoping that at the spring meetings of the IMF and the World Bank, that there would be some sort of multilateral reaction. Unfortunately, we couldn't even get a communique out of the G20, so it didn't happen. So we've got to get moving on this issue. I mean, there are lives involved here. This is not just livelihoods. This is lives.
But no Plaza Accord, nothing that would actually help anyone coming
Not
together.
in this environment.
Why not? Because everyone's looking after themselves?
They're looking after themselves. The amount of multilateral coordination is quite low.
Yeah.
You have tensions between the US and China. Right, so it is hard to get everybody in a room and to agree. Remember, they couldn't come up with a communique, and you and I know that these communiques tend to be
wishy-washy.
Wishy-washy, but if you can't, so multilateral coordination is challenged right now.
Yes, the benchmark is pretty low. You're right, if you can't even get a communique out. All right, talk to me about the idea, which fascinates me, that Andrew Bailey, that frankly has come under a lot of flack here in the UK for being so candid, asking also employees not to ask for raises because that would make his life easier in dealing with inflation. The fact that you admire that actually he's so upfront and sometimes saying, well, look, we messed up, but I'm not really sure where we are in 3 months from now.
Yeah, and I think it's his brutal honesty that has taken people by surprise outside the economic profession. But within the economic profession, it's admired. The role of a technocrat is to express opinions as they see it and not to be politically influenced. Because if technocrats are politically influenced, then no one expresses opinions as they see it.
But it doesn't make his job any easier. I mean, this is a small, open economy. Inflation's higher almost than anywhere in the world. And actually, it's extremely difficult to see what he does with interest rates.
Right, and it certainly makes his job a lot harder. But remember, he's dealing with an inflation rate that is also being impacted by delayed price adjustments. The gas price adjustments that kicked in April are delayed. That should have happened last year, and now it's coming on top of everything else. So yes, he's dealing with a high inflation rate. But again, look at the Bank of England. They moved first in acknowledging that inflation isn't transitory.
Yeah.
They moved first in hiking rates among the major central banks, and they've moved first in being brutally honest. I think actually that they continue to set an example for other central banks.
Okay, in 30 seconds, the ECB, I mean, that seems like also another nightmare. Can they really hike as much as the market thinks they will?
That's the hardest policy challenge right now. I would not like to be in Madame Lagarde's position.
Me neither. Well, thank you so much, Mohamed Nalarian there, Chief Economic Advisor, President of Queen's College, Cambridge, and Bloomberg opinion columnist. I could speak to you for another 3 hours, so you have to come back, Mohamed. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Katie Lyons in New York, Anna Edwards here in London, and this is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? combustion engines get electrified.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
There's just a lot of pessimism in the market, more than we've seen in years.
People are looking at the glass as being half empty. There are a lot of half full notions out there as well.
What we're shifting to now is a market that is going to be dominated and is being dominated by the growth impact of that central bank shift.
Don't fight the Fed is definitely the mantra in the bond market, and the Fed seems to be on a very hawkish course to continue to hike rates.
The risk case is that they have to do more, and that then also raises the risk of a hard landing.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, April 18th. Our top stories today. Jerome Powell's most hawkish tone yet. The Fed chair vows to keep raising interest rates until inflation is in retreat. UK inflation hits a 40-year high. Consumer prices soar 9%, putting pressure on the government and the Bank of England to take action. And Sweden and Finland make it official. They've now formally applied for membership of NATO, but they still have to overcome opposition from Turkey's President Erdogan. Welcome to Bloomberg Surveillance Early Edition, everybody. I'm Anna Edwards in London with Kaylee Lines and Kriti Gupta in New York. Matt Miller is off today. And Kaylee, European equity markets stalling a little bit, risk appetite stalling a little bit globally.
Yeah, that wasn't necessarily true in Asia overnight, where you actually had most stocks higher on the day, following on from the gains we saw in the U.S. yesterday. The MSCI Asia Pacific Index actually higher for the fourth day in a row, which is the longest winning streak going back to early February, a gain of about 0.8%. Now, there was one market in particular that sat that out, and that was the CSI 300 in China, but you had stocks higher in Japan and in Hong Kong, where they were up about 0.9% and 0.2%, respectively. Now, of course, what's interesting is you had Le He, the chief economic chief in China, meeting with big tech companies yesterday, talking about support for companies in the digital economy and their overseas listing. The question is whether or not investors really buy the idea that China is going to do that, and what difference will it really make in an economy that is slowing in the face of COVID-0. We saw that reflected in Tencent's results, which came out after the Asian close, showed the slowest revenue growth since the company went public back in 2004, came up short of expectations, showing the impact of the technology crackdown and the slowdown in China. Finally, I would point out that in foreign exchange, the Japanese yen is the outperformer in Asia as well as in G10. It's actually the only G10 currency stronger against the dollar this morning, stronger by about 0.1%. We're trading right around 129.23, Kriti.
Yeah, Kaylee, if we're looking at green on the screen in Asia, we're actually seeing the exact opposite in future trading for the S&P 500, down about, it looks like about 0.4%. And this is important because it comes on the back of that 2% rally yesterday. So is this a true risk-off feeling, or is this simply kind of paring back some of the monstrous gains we saw yesterday? But remember, we also look at the cross-asset picture. The 10-year yield is down about 2 basis points. It's not that much of a move, just given the volatility we've seen in the last couple of weeks and months. But still, to see a bid lower into yield or a bid lower into treasuries, that's important to talk about simply what kind of mood the environment is really in. Of course, crude kind of barrels higher, 114 on NYMEX crude here stateside. But you also have to look at the crude at the risk-off picture when it comes to Bitcoin. Of course, we know it tends to be that risk sentiment indicator. And right now, it is down 0.8%. But remember, the volatility is usually about 4% in one direction or the other. So an 0.8% move to the downside, it's not that volatile, Anna. But for now, it does seem like we're heading for a risk-off day.
Yeah, and here in Europe, Kriti, I'm afraid I've got nothing inspiring to tell you to give you much direction, because we're pretty grey across this map, not even slightly green or slightly red, just
grey. We are either side of the flat line on the German market, the French market, and the UK market right now. And we're kind of evenly split in terms of sector performance. A few more sectors to moving lower today. Technology is one sector that moves lower today. Energy stocks, though, moving higher. That slightly higher energy price, oil price that Kriti was just talking about, that's pulling some of those oil giants a little higher in the European trading day. One thing that has been anything but grey and anything but boring is the inflation story here in Europe. And we've had those numbers through from the UK earlier. We got Eurozone inflation data just a moment ago. Came in pretty much as expected. It was another reading on some numbers we previously had. This is where we are on the pound, though, today, down by 0.9%. And we got a really high inflation print, at least by recent history, of course, 9%. But it wasn't the 9.1% that had been tabled by economists. I know that wasn't much of a miss. But yesterday, we spent a lot of our time repricing in hikes from the Bank of England based on the tightness of the labour market. Today, we're just rethinking some of that a little bit, and we see the pound down by 0.9% then. 5-year yield in Russia. I wanted to put this in here because of movement that we've seen, or commentary, plans by the Biden administration to stop the Russians from paying their dollar-denominated debt in dollars. And as a result, we've seen a spike up in yields, as you might expect, on the 5-year horizon, certainly. Siemens Gamesa, this is a renewable energy business over in Spain, up by 11.5%. It's been struggling of late, and they have a big shareholder, which is Siemens Energy. They have decided they may take ownership with a big cash offer and delist this particular business. TUI is a travel business in, well, straddles kind of the UK and Germany. They owe the German government quite a bit of money since the COVID pandemic. They decided to issue shares to pay back the German government, and as a result, the stock trading down by 11.4%. So this long COVID, as demonstrated in the equity markets, Kaylee.
Indeed. All right, Anna, so we will continue to keep an eye on those shares throughout the day. And as for what else is ahead on this Wednesday, G7 finance ministers and central bankers will begin a meeting in Bonn, Germany. You'll also have Target reporting its earnings results before the bell here in New York. Interesting to see what kind of inflationary pressures that company is dealing with after the pretty dismal results from Walmart yesterday. And finally, it's one of the busiest voting days of the U.S. 2022 elections, with primaries in Idaho, Kentucky, North Carolina, Oregon, and Pennsylvania, Kriti.
Yeah, Kaylee, let's bring it back down to D.C., though. Now to the most hawkish remarks yet by Fed Chair Jerome Powell. He says the Fed will keep raising interest rates until there is, quote, a clear and convincing evidence that inflation is in retreat. Powell spoke during a Wall Street Journal live event yesterday.
Inflation is coming down. That's what we really need to see. So we're watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't. And honestly, we will go until we feel like we're at a place where we can say, yes, financial conditions are in an appropriate place. We see inflation coming down.
Let's get more with Bloomberg's Danny Berger. Danny, how significant were Powell's comments, or did we kind of already know this when it comes to the market impact?
Yeah, we knew that he was hawkish. It's not surprising that he continued that hawkish message. But one of the things I found interesting was his real endorsement of the market pricing in that hawkishness. He mentioned that the 2-year yield, that's been a pretty good indicator of where policy direction is going. And on his comments, we saw the 2-year yields rise about 13 basis points yesterday. So perhaps the front end of the curve isn't all hawked up. He also talked about the fact that they're not just hitting and holding. They're not going to wait around to see whether some of the supply side constraints start to ease up. They're going to do what they can, and that means demand. That's why it's not surprising when Jay Powell was asked, are you concerned about the turmoil in the markets? He said, no, look, it's orderly, and it all goes towards this goal of tightening financial conditions. And so financial conditions, yes, they have been tightening. They still perhaps have a way to go to meet Powell's target, but I think this terminal, and for our radio listening audience, it's the Bloomberg U.S. Financial Conditions Index is one you really got to pull up every day, because this sets the backdrop for the current policy background.
And Danny, here in Europe, we've had UK inflation data. We've had the Eurozone too, but the UK one really moving markets. The last time we had inflation this high, Danny Berger, I was 8 years old. Don't remember how that felt too much, but I'm certainly experiencing this bout of inflation. 9% now, the UK number, and yet the pound falls.
I probably shouldn't tell you where I was at that moment, because I may or may not have been alive. However, yes, 9%, 5 times higher than the Bank of England's target. And this puts them in a really difficult position, because just yesterday we had this really tight labor market data, the lowest unemployment in near half a century. So it means that they just have to really do more. They have to act more forcefully in order to create some slack in this economy, given these inflation numbers, given the unemployment numbers. But it's also interesting that given all of that, The market reaction today was one of sending the pound weaker. It was also one of pricing out rate hikes out of the market. The pound down nearly 1% versus the US dollar. And it kind of just shows the market's disbelief that the Bank of England can handle this and get the economy under control. This is a market trading like it's preparing for stagflation.
Danny, thanks very much. Bloomberg's Danny Berger with the latest there on the broad market thinking and the UK story. Now on to geopolitics. Sweden and Finland submitted their applications to join NATO earlier today, marking the start of a formal process that would fortify Europe's defences and make it more secure in the event of Russian threats to the region. NATO Secretary General Jens Stoltenberg spoke earlier.
I warmly welcome the requests by Finland and Sweden to join NATO. You are our closest partners, and your membership in NATO would increase our shared security.
Bloomberg's NATO reporter Natalia Drozdiak joins us now from Brussels. Natalia, walk us through the latest then. What is happening now that Sweden and Finland submitted their bids?
So the next step in this long process is for representatives of NATO member states to formally accept the application so the countries can start accession talks. Ambassadors are meeting at the moment, but it's unclear whether there will be such a statement today since all 30 have to agree. And this had always been seen as a quick formality that would be agreed very swiftly. But now that Turkey's voiced last-minute concerns, it's unclear if and how much that will be delayed.
Natalia, I'm glad you brought up Turkey, but can you explain to our audience why Turkey is blocking this and the likelihood that they'll succeed?
Well, you know, in the run-up to these expected bids, the focus had always been on Russia's reaction, and allies had said everyone would be on board. Now, Turkey in recent days said Sweden and Finland were supporting Kurdish militants it viewed as terrorists, and said it was unacceptable that the countries have restrictions in place on weapons exports to Turkey. NATO officials have tried to play down the issue, saying they were confident it would be resolved, given how important it would be to have the two in their alliance. But the concern is also if they block, it would be a major victory for Putin, who's been calling against further NATO enlargement. One thing to remember is even if there is a statement today and Turkey allows the process to start, they could always block it down the line.
Natalia Drozdiak in Brussels, thank you as always for joining us. From Brussels, let's go to D.C. The U.S. preparing a military aid package for India as it looks to deepen security ties and reduce New Delhi's dependence on Russian arms. Bloomberg sources say the package could include weapons financing of as much as $500 million. Meanwhile, the Biden administration is set to bring Russia closer to the brink of default. Bloomberg's learned the Treasury Department will move to fully block Moscow's ability to pay U.S. bondholders as soon as next week. Anne-Marie Hordern, Bloomberg Washington correspondent, joins us now from D.C. Anne-Marie, so much to digest here. Give us the latest from the Capitol.
Yeah, well, this is a Bloomberg scoop, and if Treasury does go ahead and really not allow this a waiver to continue and allow it to elapse, it brings Russia potentially closer in this debt saga to actually defaulting on its debt. Now, there is someone in the Treasury who says they haven't yet made a final decision. There was a lot of debate about whether or not you continue to allow Russia to draw down their money and allow these debt payments, but obviously also if you push them into default, that is going to be catastrophic for the Russian economy. The finance minister over in Russia, though, maintains that they could still pay off their debts, but by doing so using rubles. So there does seem to be a little bit of, question marks. What also counts a default because someone is willing to pay, but they aren't able to. But what we do know is that the Treasury is expected to really let this temporary exemption lapse, this carve out, and that means that it's going to be much more complicated for Russia when it comes to paying their debts.
Anne-Marie, meanwhile, with a focus on domestic politics, today is, of course, Wednesday, the day after a big primary Tuesday in which we saw primaries in a number of states, including Pennsylvania, where it's too close to call between Oz and McCormick in that Republican primary. What are we learning about the power or lack thereof of a Trump endorsement?
It's a great question because if you look at the map, and there's a ton of primaries last night, Idaho, Oregon, Kentucky, North Carolina, but Pennsylvania is really where it's become very dramatic. We don't know yet about Trump's hold in Pennsylvania, but if you look across the map, you could see that potentially some of his grip is wavering. Some of his candidates won and some others did not. In Pennsylvania, though, it's been really a tough race for weeks, and it became at the last minute a three-way heat. Now it is squarely very close, razor thin, between Bridgewater Associates CEO, former hedge fund manager David McCormick, and Mehmet Oz, which many of us grew up knowing as Dr. Oz. Of course, Dr. Oz is the one that is backed by President Trump, but interestingly, if you look at the makeup of David McCormick's team, it's a lot of ex-Trump employees. So what we do know now is that it's so razor thin. Both these candidates did come out and say it is too close to call at the moment. We're going to have to give it some time. But this is a really important race. People are not just focused on Pennsylvania because the drama behind it and some of the celebrity names, but because what analysts are saying is that Democrats are poised to lose the House, right? And this is potentially a moment. This seat would be replacing a senator seat from a Republican senator, Pat Toomey. Potentially, Democrats think they can maintain control of the Senate. This could be one of the key seats. We still need to wait for these results, but clearly you can see very different ideologies of the Republican Party have a razor, and it's razor thin right now.
Indeed, and November is drawing ever closer. Thank you so much to Bloomberg's Anne-Marie Horton in Washington for us. Now let's get back to the markets and take a look at one company story in particular that has caught all of our attention in recent weeks, and that would be Twitter, whose board says it plans to enforce Elon Musk's $44 billion bid. They're trying to inject some clarity into the situation as traders bet on Musk walking away from or renegotiating the deal. We spoke to Arjuna Capital's Natasha Lamb in Boston yesterday. Just take a listen to her take on the matter.
I think Twitter has had so many challenges over the years, which is why you've seen, CEOs come and go, move around, why you're seeing what's happening with Elon Musk right now. Unfortunately right now, I feel like Elon Musk is like a cat playing with a ball of string.
Absolutely love that simile. Now let's take a look at how Twitter is performing in pre-market trading, because it continues to trade substantially below Elon Musk's offer price of $54.20 a share. Right now, trading around $38 a share. That's about 30% below that. It's lower by about 0.3% this morning. Another stock to keep an eye on is one of the big movers of yesterday. That would be Walmart. After it cut its profit forecast due to the inflationary pressures it is facing, the stock had its worst day since 1999. In the Tuesday session on this Wednesday morning, no rebound really to be seen. That stock lower by about 0.2%. And it is a big plunge to the downside for Doximity. This is an online healthcare platform. It reported after the bell yesterday, both its quarterly results and forecast missed expectations. You have a number of analysts cutting their price targets as a result. That stock down a whopping 17% before the bell, Anna.
And Kaylee, coming up on this program, then we'll talk about these markets with Jeffrey Yu joins us, BNY Mellon Senior EMEA Markets Strategist. What does he make of the inflation pressures, the latest from the Fed? And talking of which, Charles Evans adding to the hawkish tone. Catch our exclusive interview with the Chicago Fed president at 9:30 a.m. New York time. Plus, the last of Lehman Brothers. In today's Big Take story, we take a look at the people attending to the bank's last remains ahead of its final court cases. Just type NI Big Take into your Bloomberg terminal. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
election season continues.
There's so much nervousness in the market right now.
This market punches you in the face.
Bloomberg is fastest with the numbers and analysis.
Big numbers from Disney.
It just slammed expectations.
Bloomberg, the fastest numbers and analysis you trust.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lyons in New York and Anna Edwards in London. Matt Miller is off today. I have a little bit of a depressing chart, but I think it really feeds into the market narrative right now. We're looking at the Fed Misery Index hitting a 30-year high. Essentially, it combines inflation and unemployment. And you can see for our TV audience, for our radio audience, stick with you, it's really at the highest going all the way back to really the late 80s. So this is really important when we're talking about the comments we heard from Chairman Powell yesterday at, of course, that Wall Street Journal event, saying he really wants to tackle inflation and tackle inflation hard. Let's bring in Justina Lee, our Bloomberg Markets reporter, to talk about what this actually means for the markets. Justina, does the market care? Didn't we already know this?
Yeah, that's a good point. But I think even by Fed's recent standards, I mean, yesterday's comments were pretty hawkish. And I think the takeaway here is that Jay Powell really prioritizes fighting inflation right now, even if that means hurting the economy in the short run. So I think for a lot of bond investors that are asking themselves, you know, haven't we priced in enough bond rate hikes already? I think the answer there is like, if we don't see the CPI coming down convincingly, then maybe the answer is no.
And where does this take us then in terms of slowing down the US economy, Justina? Because there seems to be an admission that, yes, they do want to slow things a little bit. That's the point of what they're doing with financial conditions, of course. But at the same time, they see that they can land this. They think they can land this okay. I spoke to one guest this morning who says he doesn't see conditions for a recession in the high-yield credit market, for example. That's where he was looking. What is the view out there about whether they are creating conditions for a recession right now?
Yeah, it's definitely true that I think for now, most market participants don't really see signs of a recession. I mean, we had pretty decent U.S. data yesterday. You know, retail sales and factory production both beat estimates. But I think the concerns there are a little bit more medium term. I mean, historically, we know that when the Fed hikes rate, you know, pretty rapidly, it's quite hard to avoid a recession. And so we kind of have to see whether this time will be the exception.
Yeah, quite robust retail sales yesterday, despite those savings being depleted. Justina, thank you very much. Bloomberg's Justina Lee with us on the markets. And for more market analysis, you can check out the Markets Live blog, MLIV Go. That is the function to use on your terminal. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now,
you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition, now keeping you up to date with news from around the world with the first word. New COVID outbreaks in China raise the risk of more disruptive restrictions. Beijing reported an increase in infections on Tuesday. A cluster is also ballooning in the Sichuan province. All of this is slowly happening as Shanghai slowly emerges from a 6-week lockdown. The European Union is set to unveil a number of measures aimed at reducing dependence on Russian energy. The $205 billion plan will focus on cutting red tape for wind and solar farms. The goal is for renewables to make up an increased target of 45% of its energy needs by 2030. Goldman Sachs and JP Morgan will earn a combined $133 million in fees for advising Twitter on its $44 billion sale to Elon Musk. That's if the deal actually goes through. According to a filing, Twitter agreed to pay Goldman $80 million, while JP Morgan would get $53 million, most of which is payable once the deal closes. Meanwhile, shareholders dealt a rare defeat to JP Morgan's billionaire CEO, Jamie Dimon. Only 31% of them backed the pay packages for Dimon and other company leaders. The vote is non-binding, but the bank says it takes shareholder feedback very seriously. Several months ago, JP Morgan's board gave Dimon lucrative incentives to stay on for a number of years. Coming up, we'll get back to the markets, talk about UK inflation, Jerome Powell's comments yesterday, all of it with Jeff Yu, BNY Mellon Senior EMEA Market Strategist. This is Bloomberg.
Estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Jerome Powell's most hawkish tone yet. The Fed chair vows to keep raising interest rates till inflation is in retreat. Powell told a Wall Street Journal live event the economy is strong enough to withstand tightening. UK inflation hits a 40-year high. Consumer prices saw 9%, putting pressure on the government and the Bank of England to take action. A big chunk of the increase came from a rise in energy prices. And Sweden and Finland make it official. They've now formally applied for membership of NATO. But they still have to overcome opposition from Turkey's President Erdogan. Erdogan alleges both countries support Kurdish militants that Turkey sees as terrorists. I'm Anna Edwards in London with Chrissy Gupta and Kaylee Lyons in New York. Matt Miller is off today. And back to the markets, Chrissy. European equity markets losing their footing just a little bit. US futures looking a little bit weaker. We've heard it all before, in a sense, from Jerome Powell, and yet that sentiment weighs on market appetite a little.
It certainly does weigh on it, but I have to ask how much of the moves you're seeing, this real risk-off tone, actually has to do with the fundamental drivers as opposed to perhaps a technical move, essentially a rebound, or I should say a pairing of the gains that you saw from yesterday's rebound. 2% gains in the S&P 500. It's only natural when you see that kind of fast and furious rally to see a little bit of a pullback. And I wonder if we're getting a little bit of a whiff of that in futures, only down 0.4%. And I say only with a grain of salt simply because in the volatility we've seen the last weeks and months, futures trading has been a little bit more to the downside or to the upside than just 0.4%. So we have to keep our eye on that. But if you look cross-asset, you can see a similar tone. The 10-year yield down 2 basis points, but it's the fact that the treasuries are actually getting a bid that kind of creates or supports that risk-off tone. You see a similar story with Bitcoin down 0.9%. The only outlier here is, of course, oil at a 114 handle, but we know that commodity story is ongoing, so we can't necessarily fold it into that overall risk-on or risk-off picture for that matter.
All right, Creedy, and I'm not sure how much you can fold into anything in the macro picture in terms of what's happening between Elon Musk and Twitter, except that prices for big technology companies in general are much lower. So maybe he's questioning whether he really wants to pay $54.20 a share for that company, because he seems to be throwing as much cold water as he can on the idea that this deal is going through, at least in the near term. It's really difficult to follow the headlines, and there is a question of whether Elon Musk even really wants to buy this company or if he's looking for a way out. Obviously, we are still awaiting the answer to that question, but as we do so, and as Twitter says they are committed to that $44 billion deal, we are still seeing the shares, while higher by about 0.5% in early hours, trading far below that offer price, right now at $38.50 a share, so almost 30% below that. Also, I would point out that Tesla, Elon Musk's other company, is moving lower to the tune of about 1%. You did have a price target cut over at Piper Sandler overnight due to the headwinds from China. Now a $1,035 price target on that stock is trading right around $7.54 in early hours this morning. You have another EV maker, Rivian, lower by about 1.6%. And finally, I also wanted to point to Coinbase because, Anna, it's only down about 2% in early hours this morning, but after a 13% move higher yesterday, that was the 9th trading day in a row. The stock has moved to the upper downside by at least 9%. Really remarkable swings for a $15 billion market cap company.
Volatility in crypto, who'd have thought it? Let's have a look at where we are in Europe then, Kaylee. We've got European equity markets retreating just a little bit, as we were just saying there with Chrissy, moving lower here in Europe, down 0.1%. Energy stocks, though, doing well. Chrissy was showing us the oil price at the moment, and that is benefiting some of those energy majors or oil majors here in Europe. We have some technology stocks moving a little bit lower, also moving lower. The pound down by 0.8%. Yesterday, we saw a gain of more than 1%, and we were pricing in more rate hikes from the Bank of England because of the tight labour market. Today, we're removing some of that pricing in of hikes from the Bank of England, not because we got a low print on inflation. We got 9% inflation here in the UK, but it wasn't above estimates from economists, and so perhaps that is something of a corner we are turning. Siemens Gamesa, renewables energy company, this is up by more than 9% over in Spain. One of their big shareholders, that is Siemens Energy, they are considering putting in a cash offer and taking this company private. TUI is an interesting one, down by just over 10%. 2.5%. This is a travel and leisure stock, a vacation business based in Germany and also with operations in London as well. And the stock is weaker because they're raising money so they can pay back the German government that lent them so much money so that they could get through the COVID pandemic. It just shows, Chrissy, that we are not entirely done with that story yet.
Not entirely done with that story, and it's really interesting how this is actually folding into the markets broadly, because sure, we see this risk-off tone perhaps in today's trading, and we have the Federal Reserve in the background, but I also have to ask about the currency picture and how much of that COVID story and the strength of the economy and the exposure to the COVID story, whether it's zero lockdowns in China or here in the States, and just in terms of how much of that is actually increasing stateside, feeds into the currency picture. There is no better person to ask about that than Jeffrey Yu, BNY Mellon Senior EMEA Market Strategist. He joins us now. We thank you so much for joining us. Let's start there.
Thank you.
Dollar strength seems to be a major theme of the story, and a lot of people are saying this, of course, in response to a very hawkish Federal Reserve. But I also wonder how much of this is simply a function of capital flows. After all, you can use the dollar for anything: oil, sovereign debt, U.S. stocks, name your pick.
Sure, yeah, it really is a combination of both. If we look at risk aversion, then people want to own the most liquid safety asset, and ultimately people will gravitate towards U.S. cash. You know, I'm even cautious about saying U.S. Treasuries anymore because if the curve steepens, then your total return may suffer there. So really, it's just front-end U.S. and U.S. cash. There's demand there. But at the same time, we do think that the Fed is leading the way in tightening global financial conditions. You know, real rates are still rising in the U.S., and I don't think we've seen an end to that yet.
Good morning to you, Jeffrey. Very nice to see you. There seem to be a lot of things that are like the 80s right now. I mean, a lot's like the 70s, some people tell us, but things like the 80s. We've got UK inflation like it's 1982. We've got talk of plaza accords like it's the 1980s as well. And this links into what Chrissy was saying about strong dollar. Right. We see strong dollar this morning, and there is this chatter in the markets as to whether we would see cooperation amongst G7 or some grouping to try and weaken the dollar. Is that something you anticipate?
Absolutely not going to happen. I want to be very clear on this here. Asian central bankers, they have very, very long memories, and the people in charge of these central banks right now, they will say that Japan's lost decades perhaps was a direct consequence of the Plaza and Louvre Accords all those decades ago. So this is absolutely something they will not risk.
Okay, and not in any other fora then? Because, I mean, maybe, you know, France, the UK, well, the Eurozone, the UK, others could come together and do something.
So it's interesting to mention here because the last time there was sort of, the first time Euro intervention took place was during the first years of the Euro. Back then, they were seen as undervaluation by the ECB. So they did come in to support the Euro to some extent. But again, that was a function of absolute and relative growth expectations. If the US continues to power ahead in growth and policy powers ahead, it is what it is.
All right, Jeff, so if the ECB hikes in July, what will it mean for the euro, considering in theory that would help, yet it looks like an ECB that's going to be hiking into weakness?
So July has been well telegraphed, and we are quite surprised that not only in euro dollar, but euro on the crosses, you know, there's really been lack of movement right now. So I think there really is this underlying concern that even if rates go up in the eurozone, it's still quite some distance compared to where the Fed is. And secondly, as you say, hiking into weakness, and there are lots of risks, the euro-specific risks right now. So I think markets are saying, yes, the ECB are hiking, but plenty of other central banks are hiking right now. I'm not just going to take my chances with the eurozone, so putting money to work elsewhere in the US, Latin America, and EM. Yeah.
Well, and across the world, in Europe and the US as well, you're starting to see some concern about the weakness that central banks are hiking into, reflected in the bond market, where we've seen yields coming off of their highs of the year. Are we moving back into a world where bonds actually do act as a hedge and your 60-40 portfolio is going to work again?
I think we will start to gravitate towards that, but I'm not ready to call a trend-wise rotation back into bonds yet. I don't think we get to that point until the market really full in prices in what the Fed could do. I'm not saying they will do, but until we start to think about 4% Fed funds rates, you know, where terminal rates are, and really just backing up what Chairman Powell said, restrictive rates, there will still be steepening risk. So bonds, I think there is some coming back. Take the UK, for example. If I had to pick one central bank in G10 at risk of a pause, then probably it's going to be the BOE. They have a longer maturity profile in the gilt market, so I think that's where you could see a case for greater hedging via gilt. But across the board, until the Fed calls time on expectations, I don't think we're there yet.
Jeff, I'm so glad you brought up the BOE because, of course, we did get data here that inflation is a 40-year high at 9% in the UK. But I'm curious what that means for the cable rate. We're looking at 123, 124 now. Do we hit 120 in the next couple of months?
So to be clear, we're still quite negative on the UK economy in terms of real income growth. That's something that BOE has flagged. 120, if we hit there, I think those are good levels to actually come back. So valuations, as much as we're cautious on the UK economy, valuations in cable in particular are more attractive right now. So I think buyers may come back in.
Okay, so buyers may come back in, but how weak does the UK story get, do you think? I mean, inflation running at 9% right now. Bloomberg Economics says it doesn't dip below 8% this year. The Bank of England says it could go to 10% in October when we get another review of the energy price cap. So that's the inflation side of things. When does that inflation start to sort of eat itself and really put a brake on the UK economy?
I think it's already putting a brake on the UK economy already. If you look at the labour market data yesterday, yes, it was strong. Is it shooting out the lights? Are we going to get double-digit rate growth, wage growth to push real wages higher? That's not going to happen. There's only downside risk to the BOE's current forecasts for real income, and considering how much the UK economy depends on spending, around 70% or so, then it's really going to be a problem. So that's why I went back earlier. If there's one central bank, major central bank, that could pause in the near term, it could be the BOE.
Well, and of course, there's a number of central banks in Asia that aren't in fact hiking at all, so they don't need to pause. They're easing, including the PBOC in China. Jeff, how are you viewing the China story right now? And when Beijing says they want to support the markets and the economy, can they be believed?
Well, right now, I think markets are really taking this with caution, because you can say, launch projects and say activity is going to happen, but until COVID policies, until we get to the other side of that, markets are just going to say if people can't do much, then you can put money to work, you can deploy credit, but ultimately activity on the ground is going to be soft. So that's why we're not seeing the CNY strengthen aggressively. We're not seeing Asia risk being lifted as well. And one final issue there is if China eases, if the PBOC cuts rates, or dollar CNY continues to strengthen, it's going to really restrict room for maneuver for other central banks as well.
Jeff, thanks so much. Thanks for spending time with us. Jeffrey Yu of BNY Mellon. Coming up on the program, Tencent's revenue missing estimates this morning. What do these results mean for Chinese tech companies from here? We'll get analysis. This has been a big talking point, of course, over in China. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Kriti Gupta in New York and Anna Edwards in London. Well, of course, now we have to turn to China's largest social media and gaming giant, Tencent, posting its slowest revenue gain on record. That's after lockdowns and a sweeping government crackdown wiped out growth. Remember, this is the slowest revenue growth this company has seen since it went public in 2004, really seeing the impact of not just the crackdown on technology, but also the slowing of the Chinese economy in general due to COVID-0 policy, Kriti. And the question is, now that Tencent's growth has slowed to this extent, what will make it come back? What do you need to see out of Beijing policy-wise?
You know, and this is so important when we're talking about just the amount of pain that has been seen in a lot of these tech companies, essentially, and a lot of the Chinese stocks, I'll say broadly, investors basically pulling out because of that regulatory scrutiny. But how much of a drawdown, I think an 80% drawdown from its peak, is enough to buy the dip, actually? So, Anna, this is going to be fascinating when it comes to how low is super attractive.
Yeah, absolutely. How far through the crackdown on tech names are we? And what difference does lockdown make then, Kaylee? Because in other parts of the world, of course, big tech has benefited from that kind of environment. But what's the China story?
All right, well, let's get an answer to that question. Bloomberg Opinion tech columnist Tim Kolpin, who's normally based in Taipei, is with us in the New York studio today. Tim, it's great to see you. I believe this is the first time you've been back in New York since before the pandemic hit. So when we look at Tencent, which has seen growth slow now for 7 straight quarters, we're talking the lowest rate since 2004. What do you need to see from Beijing to bring that back?
Well, interesting, we've been seeing some of the signs that we'd be wanting to look for from Beijing already the last few days, in fact, the last couple of weeks. Signs coming out of Beijing from the central government is saying, hey, we do actually need to support the platform economy. And there's indications essentially that the crackdown may be over. And so as Tencent reports today, it's just reported about an hour ago, we went through the numbers just now, we have an investor relations call coming up. People will be looking at the numbers less, I think, this time, and looking more at kind of passing the words that come out of executives' mouths. What are they hearing from Beijing? You know, everyone's trying to read the tea leaves here. And so the executives are at the forefront of this problem or challenge are the ones that we want to look at more closely to see what they want to tell us. But they're not going to be too open. They're not going to share too much. They've also still got to keep, Beijing on side. So it'll be very, very interesting to read what they have to say. And I think investors will be kind of putting these numbers behind them and looking forward and kind of guessing, is this the bottom in terms of course, the share price, but in terms of revenue growth and, of course, the crackdown. Maybe things are going to be looking up from here.
I'm glad you hit the share price because that's where I want to go next. This idea that you've seen such a big drawdown already, but has a lot of damage already been done in terms of relationships between China and the rest of the world? Sure, the regulatory scrutiny is easing now, but there is a possibility that it could ramp back up. So how much damage has actually been done?
Yeah, look, a lot of damage has been done in terms of what's been going on within China internally. Not only the crackdown, but of course the crackdown on COVID has been very severe in Shanghai, Shenzhen, now looking at Beijing. So there's definitely a macroeconomic effect with inside China. And it doesn't help if China's relationship with the rest of the world is not as robust as it could have been, say, 5 years ago. But, one thing about Tencent, for example, is it's a very internally focused company. And part of their problem, part of their challenge is they don't get a lot of revenue from outside of China. They're trying to push overseas. They're trying to sell their games overseas a lot more. They're kind of having not great success, but there's still that opportunity. It's potential. So if you talk about the bottom, there's always upside to get more overseas revenue. And anything that kind of causes macroeconomic uncertainty is definitely a headwind for someone like Tencent.
Tim, if we're going to see further lockdowns in China, and if that is something that we're going to see as we head towards those important meetings in the fall in terms of Chinese leadership, how will that play for big tech? Because in other parts of the world, we've seen actually some technology businesses do really well during lockdowns as people got stuck at home. How does that play out in China?
Well, you really have to pass every company individually. For example, Tencent is big on gaming and, of course, social. So on the gaming side, if people are sitting down at home, stuck inside, can't go out and about, they may be playing more games. We saw that in the last 2 years in China with Tencent and other games companies. But, of course, if they can't go out to restaurants and advertisers feel there's no point advertising because they're not going to get the revenue from it, then there'll be an advertising impact. Now, at the same time in China, we're seeing an impact on advertising because of new tighter regulations emissions of various types. So that's definitely a problem. But having said that, the government has indicated very, very clearly that macroeconomic growth, GDP growth, is very, very important to Beijing. It's very important for them to push growth, and so they will do whatever they can to juice the economy.
Tim, I think it speaks to this moment we're in where you said people playing games, and I immediately think of Elon Musk and his Twitter account and whatever dance he's doing with this Twitter deal. What is your assessment of what he's actually trying to do here?
Well, I think the chance that this deal doesn't go through at 54.20, it's a non-zero chance. It is possible it'll fail. And we've got all the advisors on both sides working their butts off to try and get this deal done, putting the documents together, getting Elon Musk's signature on it. They're working very hard to kind of push that chance as close to zero as possible. But what is he exactly playing at? It's really hard to know. My guess, you know, as an opinion columnist, based on everything that he said, everything we've seen, it's really about kind of a negotiating tactic. Maybe he's not too keen on paying 54.20 per share, given what's going on around the world, given the drop in tech shares. He's like, well, why would I pay that when maybe I can get away with paying a little less? So I think we're looking at a bit of bargaining going on.
I wonder how much thought went into 54.20, given what we know the 420 is sort of linked to. But anyway, we'll talk more about this, no doubt, as we move through the saga. Tim Colpin, thank you so much for joining us on set in New York, Bloomberg opinion columnist. Thank you. Coming up on the latest episode of Studio 1.0, Emily Chang speaks exclusively with the Roblox CEO, talking of gaming, and co-founder about the online gaming platform's explosive growth. Catch that tonight at 9:30 p.m. in New York. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Inflation is biting. We see for low income or lower income families really difficult to deal with the rising cost of energy. We also see that for companies that had investments or that were dependent on energy or on grain to a certain extent, the whole value chain has been completely destroyed.
That was UniCredit CEO Andrea Orcel exclusively speaking to Francine Lockwell on Bloomberg's Front Row in his first TV interview since taking the helm. Now, we're joined by a very special guest, Tom Keene, co-anchor of Bloomberg Surveillance. He joins us now with his single best chart. Tom, what do you got?
This is a little background story. It's something off the radar of America and, frankly, the Western Hemisphere, and it is Japan. It is the absolute disaster, which is the lack of Japanese economic growth. This is something I've talked over the years to many leading economists about. It's just simply the Japanese malaise, the boom out of the 80s up to 1997, and Japan basically flatlines through the global financial crisis, a very modest recovery, and create a rollover off of COVID. It is stunning how nominal GDP based in yen has gone nowhere for 25 years.
Interesting, and interesting that one of our previous guests, Jeffrey Yu, was linking that to the Plaza Accord back in the 80s, which I know is back as a talking point right now with the strength of the dollar, Tom. Good topics to talk about then with Seth Carpenter, who joins you.
Well, today we've got Seth Carpenter with us with Morgan Stanley, but a lot of other good guests. It's a really nuanced day, Anna, coming up. We start strong with Kit Jukes. We will talk to him about pound sterling and Governor Bailey. And we'll also talk to him about the collapse of Arsenal, which Anna Hahn could care less about.
Is that the Tots, Tom? I can never keep track.
No, the Arsenal's not the Tots.
Okay.
They're like arch rivals, and they play in a derby, except they call it, Kelly, they call it a derby, except it's spelled derby, and I don't understand.
All right, I learn something new every day. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. Now, something else we're going to learn today is how much results from Target and Lowe's reflect what we saw from Walmart and Home Depot, their big rivals yesterday. Of course, Walmart dealing with inflationary pressure. It saw its worst day since 1999 yesterday off the back of a cut forecast. But Home Depot looks like demand is still hanging in there, even in the face of higher mortgage rates. So how much will Lowe's benefit from that, and how much could Target face those same inflationary forces, Creedy?
Well, Kaylee, well, speaking of mortgage rates, I'm watching U.S. housing starts, that data coming out at 8:30. Do you start to see that construction boom continue? How much of damage are we going to see with that perhaps decreased demand, Anna?
Yeah, absolutely. Good topics of conversation, of course. I'm going to be watching as the EU drafts a new plan to try and wean the continent off Russian fuels. That's going to be a big focus. Also be aware, the Turkish President Erdogan is just currently speaking about his reservations of expanding NATO to allow Finland and Sweden to join. So we'll continue to monitor that story through the hours ahead as well. That is it for the early edition. Surveillance is ahead with Tom, John and Lisa. This is Bloomberg.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
There's been a very material tightening in financial conditions over the last couple of months.
It feels like we're in a bond bear market.
Recession chatter is picking up.
People are looking at the glass as being half empty. There are a lot of half full notions out there as well.
The consumer is still out spending and has actually been pretty stubbornly resilient.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down a little more than 0.1% on the S&P. TK, it is all about the squeeze on this consumer.
It's a squeeze on consumer with a shock statistic. John, I'll let you talk about it. 9% of the United Kingdom. I went, oh, wow. But it's a squeeze across all. And what I would discern here, John, you just can't parse out energy and the rest. It's about core CPI, let's call it collegially a double of what we've seen pre-COVID.
One of the most important notes of the last 24 hours on Wall Street came from JP Morgan in the investment bank. Tom, cruel summer, why US gasoline prices could break above $6 later this year. That is a big, big deal.
Just got an invite to the in-house JP Morgan London call, John, on oil. This is Christian Malik and their team. And you know, they model out and they really walk through the why we're going to $150 a barrel, maybe only $120 a barrel. But the answer is JP Morgan and others see oil prices higher because of conventional analysis.
Lisa, if it's about the squeeze, just how much does this Fed need to squeeze?
And how much are they willing to? I mean, honestly, what Fed Chair Jay Powell seemed to say yesterday was basically a fight for Fed credibility. He came out basically saying, we're not going to take such a nuanced view of inflation. We're going to go at this hard. We need to regain price stability. That is the bedrock of this economy. And if we don't have that, we have not done our job. He was the most hawkish that people have heard him in a very long time.
So let me throw this at you. The market rallied yesterday. Let's put that to one side. If it continues to rally through the next few weeks, is that considered an unwarranted loosening of financial conditions that the Fed has to push back against? And if that's the case, for this summer, as the Fed put a lid on markets, put a lid on risk assets?
It's a little bit more nuanced than that. I agree with you, right? Because that's been basically the story, that any time there's been a sigh of relief in markets, that's a bad thing for the Fed, because it's exactly not what they want to see. However, where did it rally? You saw the havens rally, the classic havens that became the left for dead stocks, the big tech names. How much are people reverting back to a belief that the Fed can get inflation under control, even if it causes a recession? And then the behemoths to actually make money look better because yields are going to get under control over the long term. I know this is counterintuitive, but these are some of the things that I was thinking about yesterday.
One note, Bramo, front end of the yield curve. What happened? This market gets it. 2-year yields adjusted higher. They adjusted higher when we heard from Chairman Powell. They adjusted higher when we got that upside surprise on retail sales.
People are expecting them to go hard. Neil Kashkari of the Minneapolis Fed, the classic dove, said it was easy for him to be an uber dove when the inflation was low. Now it's easy for him to be a hawk and raise rates. Doesn't know if he's going to have to cause recession. A real shift on the Fed, and it is persistent and really consistent yesterday.
What a tough moment for this Federal Reserve. Tough moment for this market too. Here's your price action in the equity market on the S&P futures, -0.2%. On the Nasdaq Nasdaq 100 down about 0.4%. Yields look a little something like this: 295.86 on a 10-year, down 3 basis points, and the euro dollar 105.26. That currency pair leaves at negative 0.2%.
Among all of the economic data that we've been getting, I am really trained on all housing data because this is one area that people say has a persistency to inflation going forward. Rent inflation tends to trail the housing sales inflation. 8:30 a.m. we get U.S. April building permits and U.S. housing stats. This comes at a time when housing prices are still rising at a near record pace. How much do some of the builders respond to this at a time when labor is expensive, the input costs are expensive, and frankly, there's concern about overbuilding? If they start to decelerate, how much does that indicate a slowdown that perhaps is what the Fed wants to see, but perhaps will actually cause people to bring back some of their expectations for growth? Today, Treasury Secretary Janet Yellen over in Germany. She's holding a news conference at that G7 meeting in Bonn, Germany. It's going through May 20th. We're going to hear about the European gas potential embargoes on Russia and, more importantly, oil. But I want to hear what she has to say about the connection between actual crude products and the refined goods, because there has been a big dissonance here. Sure, we talk about oil prices, crude prices, Brent and WTI, but gas prices are on a consistent trajectory up, kind of like that JP Morgan note that John was talking about said. And that, I think, is important to note because this bleeds into the consumer appetite to continue to spend. And today, speaking of spending, retail earnings continue, Target and Lowe's before market, TJ Maxx and is at 9:30 Eastern, and then Bath and Body Works coming out after the bell. This comes after Walmart. I know Kaylee's been talking about all morning, plunging the most since 1999 yesterday after really bringing back their forecast. John, how much is this an idiosyncrasy and how much really is this the bellwether?
Down 11% in yesterday's session. Lisa, thank you. Tom, what was the story yesterday? The resiliency of Home Depot or the troubles of Walmart?
I think it's a macro call on recession. There's a lot of people out there, John, modeling in recession. It's out there somewhere. Maybe it's in closer, but there's another group, John, saying there is a resiliency. We will not get 2 quarters back-to-back negative GDP. What I would focus on, I mentioned this in the last hour, John, Japan is one indicator of the importance of studying trade, export dynamics and import dynamics, and maybe that will be the deciding point in late summer of where the United States is.
Kit Jukes thinks we need to talk more about Europe, so let's get to Kit Jukes now, the chief FX strategist at SocGen. Kit, your words. ECB rates have been negative for almost 8 years. If the economy can sustain positive rates within the next year, the euro will be a lot stronger when it happens. If. Kit, let's talk about the if. How big is that if?
Huge, enormous. I mean, okay, so the first piece is obviously the short-term elephants in the room downside risk, which is what if the gas gets turned off and natural gas gets really, really expensive. That's bad for everybody, but it's spectacularly bad for Europe. So I don't see how we avoid a recession if that happens. Even the EU Commission admits, or pretty much admits, that we'll get a recession if that happens. So that's the first piece. The second piece, you know, they've been going one way, really, lower and lower rates for long enough that you know, the first turn upwards will have a significant market reaction. And already, you know, we have clients asking, you know, where is the real sensitive point on the spread between peripheral and German bond yields in Europe? You know, all of these things. So, I mean, I would put the if in sort of, you know, 3-foot high capital letters. It's even less likely than Arsenal making the Champions League.
Kit, the hallmark of your work is in a few paragraphs, you squeeze in a lot on a lot of different countries, cultures, and economies. Right now, there is a massing, excuse my French folks, pissing match in the United Kingdom over the governor of the Bank of England, Mervyn King, the ex-governor, going after him. Ambrose Evans Pritchard in the Telegraph and others coming to the defense of economists who put their pants on one leg at a time. What's the Kit Jukes scorecard on how central bankers worldwide are doing?
They're doing their best. Look, I mean, the only analogy I can have for central bankers at the moment is we're saying, can Tom Hanks land his plane on the Hudson? But his plane this time, it didn't have a bird strike. It was hit with a bird strike, then it was hit with an electrical storm, then it was hit with lightning, and then President Putin fired a missile at it. Which Tom Hanks can do that for all the movies we've ever seen? So I give them a break. They had no chance. They did their best by flooding the system with money back at the start of the pandemic. And since then, they're literally, it's why in the end we'll get a recession because this is too hard. Well, and critics can criticize for all that.
Kit, when you say we're going to get a recession, you're talking about Europe. I know that you and your colleagues don't believe that the U.S. necessarily is headed for recession. Do you think that those dualities are basically priced into the euro-U.S. dollar already, or do you think this has more to go and you could get to parity and beyond?
I think the trouble with the euro, to me, is back to that issue with a stoppage to the gas, which brings the recession forwards in terms of time and breaks through. And I can't measure the downside to the euro from that or the probability of it happening. So how can I buy the euro? That's why I find it unbuyable at this point in time. And I would go on trading. But yes, there is a big difference in the US and Europe. I'm not sure it's completely priced in. I definitely think it's why Treasury yields have got more upside. We have not seen the peak yet. And when that happens, I suspect I'll see lower levels in the euro before we're done. I would say, though, we will get a recession. I mean, models struggle with the recession because it's difficult to work out the accumulated effect of being bombarded by so many once every 5-year shocks in a 2-year period.
Kit, you sound like a hard landing guy. You just said we'll get a recession. That's not really the call, though, is it? It's about magnitude and timing. Where are you on that?
I kind of think next year is really the difficult year, but it could come again. There are things that can make it come forward. So, when you're talking about oil prices are up and then saying that other prices are up more, every other version of oil that I use is up more than crude. So most is jet fuel. Diesel's up a lot. Heating oil's up a lot. So they're all up by more than crude. So if we get another push higher in crude, it's going to really hurt. If this summer's harvests give us brutal food prices, that's going to really hurt. The housing market in the UK is just threatening to roll over now, and yours could follow. So, I would say recessions are pretty likely in 2023 in lots of places. I think it's just plain blind luck if we can avoid them with the number of pressures coming to the system. But Europe is right in the firing line. That's really the problem.
Kit, awesome to catch up. And just remember, you brought up Arsenal. Tom ignored it, and I didn't mention it. Okay? Just
remember. We're trying to be, it's...
We're still friends. Kit jokes are such a Kit. Thank you, buddy.
That you didn't ignore it.
No, just highlighting the fact that he brought it up and Tom ignored it, and I'm not going to build on it. Okay? We won't build on that. We'll talk about this squeeze of the consumer, stuck between a rock and a hard place and a central banker with no idea how to respond to it. I'm looking to the UK, Tom. What a brutal moment for the United Kingdom. And I go back a couple of weeks ago to a Bank of England decision where we all asked the same question. Is this in the future of the Federal Reserve? And if it is, we got some problems ahead.
With all this conversation this morning and in the uproar in the United Kingdom with a very different economy, John, it just drags me to July 27th. I think the Fed talk right now is easy. I mean, it's simple. Boy, does it get hard after the next meeting.
It gets harder for the UK and the ECB, for Europe.
Right now.
The question is, Lisa, when do we actually see a peak year-over-year inflation rate in the UK and Europe? Because we might have seen it stateside. I'm not sure many people think we've seen it there.
Yeah, and does the ECB take the same tone that Fed Chair Powell did yesterday? We don't really care where the inflation's coming from. We got to get it under control.
Futures down 0.2 on the S&P. The market is okay. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Rishika Gupta. They're the most hawkish remarks yet by Federal Reserve Chair Jerome Powell. He says the Fed will keep raising interest rates until there is, quote, clear and convincing evidence that inflation is in retreat. Powell told a Wall Street Journal live event the economy is strong enough to withstand tightening. Inflation in the UK has risen to its highest level in 40 years. Consumer prices surged 9% in the year through April. A big chunk of the increase came from a rise in energy prices. All that will add to pressure for action from the government and the Bank of England. And Finland and Sweden have made it official. They've now applied for membership in NATO, a move that reshapes Europe's defenses. Still, the two must overcome opposition from Turkey's President Erdogan. Erdogan alleges both countries support Kurdish militants that Turkey sees as terrorists. And scandal-plagued Republican Congressman Madison Cawthorn lost his bid for a second term despite last-minute backing from former President Trump. North Carolina State Senator Chuck Edwards beat him in the Republican primary. Nearly every Republican leader in the state opposed Cawthorn. And the board of Twitter says it plans to enforce its $44 billion agreement to be bought by Elon Musk. Directors voted unanimously to recommend that shareholders approve Musk's bid of $54.20 a share, almost $16 higher than where the stock closed Tuesday. The board statement came as Musk appears to be maneuvering to ditch or renegotiate his offer. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
The biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. earnings season continues.
There's so much nervousness in the market right now.
This market punches you in the face.
Bloomberg is fastest with the numbers and analysis.
Big numbers from Disney.
It just slammed expectations.
Bloomberg, the fastest numbers and analysis you trust.
Inflation is coming down. That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't.
Chairman Powell focused on one thing, getting inflation back down from New York City futures negative 0.2% on the S&P. On the Nasdaq 100, softer as well, down about 0.5%. It yields a little bit lower by a basis point to 297.14 on a 10-year. Crude very close to 114, 113.98, up by 1.4%. TK, the average gas price in America right now pushing 460.
Yeah, the distillates is with Javier Blas's world-class coverage, John, and Lisa mentioned this earlier. John, we are done quoting Brent and really having a meaningful discussion because the distillates set Brent at a far higher price.
And Tom, the refining issue is a big, big one. I mentioned the JP Morgan note a little bit earlier this morning, about 10, 15 minutes ago. They're looking at $6 crude later this summer, maybe, Tom? $6 gasoline. You don't want to go back there with crude. I know what you're thinking.
It's a hazardous game to try to game this out. But I will say, John, much of this has less to do with the war in Ukraine and much more to do with, let's call it, microeconomics of petroleum.
Well, on refiners, Tom, and this is what they had to say. Refiners produce more gasoline ahead of the summer road trip season, building up inventories. But this year, since mid-April, U.S. gasoline inventories have fallen counter-seasonally. That's been the story.
Harsh headline, John, just out. Russia expels 34 French diplomats in retaliation.
Anything else, Tom?
No, I don't know what to make of that. I mean, the war continues and, slogs forward is not the right word here, but it continues. Back from Abu Dhabi, Emery Horton joins us now, Bloomberg Washington correspondent. She's been getting up to date on our domestic politics. Emery, I think an important question this morning with this wicked tight Pennsylvania race is the effect of the right and conservatives on the middle. What did we learn about the middle of the Republican Party, the middle of the Democratic Party in the last 24 hours?
Well, it's really a mixed bag, depending on which races you look at. It's across the entire country. We had Idaho, Oregon, Kentucky, North Carolina, Pennsylvania. You see in some places, progressives really won big. In other places, Trump candidates won big. And then you have this race in Pennsylvania that's very dramatic and everyone is laser focused on. You can see the divisions of the Republican Party. You have an ex-hedge fund manager from Bridgewater Associates, David McCormick. He has a lot of Trump employees, actually, within his campaign, but then you have the individual that is backed by Trump, Mehmet Oz. We grew up knowing him, or I did, as Dr. Oz. And it's very neck and neck in this race. And the reason why everyone's so focused on Pennsylvania, because this is Senator Pat Toomey's seat. And he's a Republican. And if Democrats were able to win this seat, they have a potential to maintain control of the Senate when many say that the House is really going to swing to the Republicans.
And what's important here, Anne Marie, is within our domestic politics, there's only domestic issues. I mean, you're just off the plane from the United Arab Emirates, and I'm sorry, international affairs is not even part of this discussion. It's about inflation, and it's about the culture wars of America, isn't it?
Well, yes, domestically, those are the important issues. Let's look at the likes of inflation, as you mentioned, and also abortion. These are going to be two big issues, a social issue, an economic issue, heading into the November primaries. But, Tom, I would argue that maybe candidates won't talk about international relations. What was going on internationally is affecting things like inflation. I mean, I had some chats with Emiratis in Abu Dhabi, and I can tell you this, and also other chats last week with OPEC officials. They're quite concerned about things happening in Congress, like this panel voting for a NOPEC bill, right? So the story of gasoline prices, which today, we're closer to $5 an average across America than we are to $4, and we are just about 2 weeks out from peak driving season. We're not even in high driving season. You may start to see candidates talk about some of the international issues going on that play into the domestic stories.
Anne-Marie, this is incredibly relevant in Abu Dhabi. I wonder how much this was about Tony Blinken going to the Emiratis and saying, please, Please give us more. Please open your taps, give other people more, make sure that our exports aren't going as strong so that we can actually shore up some sort of price stability. Was that part of the undertone of the meetings?
Well, listen, we don't know, right? So Secretary Blinken decided to go to Abu Dhabi because he was joining with the vice president and a slew of high-profile of U.S. officials, including Bill Burns, Secretary Austin, and climate envoy John Kerry. He then did meet with his Emirati counterpart. This was a closed-door session. They had dinner, and that's all we really know about it. At the same time, we don't know what the ask was, but we do know the United States has been asking OPEC producers to pump more. But the issue right now is less so oil, and it's more about refining capacity. I would say it's a bit of both. But you have the Saudi oil minister talking about the fact that it really doesn't matter if we pump more oil. The issue is you cannot turn that crude quick enough into the products consumers use every day, right. Diesel, jet fuel, and gasoline. And that's really a major issue right now going into the summer months.
And Anne-Marie, as we've been talking about for months, nuance doesn't sell in Washington, D.C., but what kind of policies, nuanced policies, could be implemented to really bridge this gap with refined goods and crude?
Well, it's difficult. You cannot build a refinery overnight. I mean, we've had refineries shut down before the pandemic. There's not a lot of investment in this industry, and this is not just the industry that feels hostile with this administration. This comes from the whole wave of ESG from the banking sector as well, and also the electorate, right? President Biden ran to be a climate president, and this really turned out a lot of the vote with the youth, especially. So when it comes to refinery, this is going to be incredibly difficult to change overnight. This is months, this is really years. And when you have already an issue and then it's been exacerbated by the war in Ukraine, because Russia itself has taken off the market maybe 1.5 million barrels of refined products. Not just of crude, of those actual refined products. And it's very tricky because now we're in the summer months, and this is where we really see peak driving demand in the United States, and also people going on vacation. Look at ticket prices; they're gonna go higher because you have jet fuel, diesel, et cetera, across the board. It just keeps going up.
Jet fuel and the airlines, just unreal. AMH, thank you. Our Bloomberg Washington correspondent down in D.C. Lisa, we touched on this a little bit yesterday. You've gone from understaffed to overstaffed. Undersupplied to oversupplied. And if you think about where the lack of capacity is right now, energy, and to some degree the airlines, and that's all deliberate.
Well, yeah, that's actually the key question. How much is this intentionally reduced supplies in order to increase pricing, as that we can see that people continue to pay those prices for airlines? Honestly, this is going to be a point of increased focus, certainly in Washington, D.C.
I mean, without a doubt. They've told us it is, though, right?
Well, I mean, but how much
the airlines have told us that.
Right, the airlines have, but how much is the oil and the gas prices really having to do with some sort of intentional price gouging?
That I'm with you.
Yeah, I mean, like,
No,
I don't know that I
with
buy
you.
that.
I'm
I'll
not
be
Elizabeth
honest.
Warren,
Yeah.
just to be clear. Okay.
A lot of people are confusing it. I will
Changed
just say.
overnight.
I was kind of shocked. I was like, who is this?
Don't worry.
No Arsenal.
I'm still here. Futures down 0.2 on the S&P from New York City for our audience worldwide on TV and radio. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City this morning. Good morning for our audience worldwide on TV and radio. Here's the price action for you on equities. The S&P 500 down by 0.2%. Futures slightly negative. Here's a headline for you. Target. It's a downside surprise. EPS coming in at $2.19. The estimate $3.06. Margins lower than expected. And margins for the year, they guide a little lower as well. This is sounding a whole lot like Walmart. Target down by 7.6% in early trading. And this CEO note from Brian Cornell, this quote, sounds a whole lot like Walmart too. Throughout the quarter, we faced unexpectedly high costs driven by a number of factors, resulting in profitability that came in well below our expectations and well below where we expect to operate over time. TK, that stock getting hit in the pre-market.
You look at 40 headlines come out, John, and I go back to the legend Philip Carret, who died at like age 102, and he would talk about the bright lights of inflation. We had a nominal GDP, John, that was a gift to performing well, 12%, 10%, 7%. The comp sales of Target don't look like that kind of nominal GDP. They look like a normal economy, and you have to adjust given the labor costs, given the petroleum costs.
It's how things fall from the top line, Lisa, to the bottom line, and the margins are getting squeezed.
Yeah, and this is what a lot of people were expecting, just how much they're being squeezed, though, even surprised the CEO. And some people, you were saying this yesterday, John, why are they surprised? We've been reporting on this. You can see what the strain is right now. However, I still find this interesting, the fact that CEOs are coming out, they're downgrading their forecasts for the full year, which also we're seeing from Target. How much is this a precursor to trying to test consumer demand pushback, raising prices for the population that can least afford to absorb them?
Well, I don't think they can raise prices anymore, and that's part of the problem, isn't it, TK? That's why margins have ultimately come in. That's something that Walmart is grappling with, and seemingly Target is too.
I don't see evidence of that yet. I think, John, you're right. We may see that as a next step. What I see is a changing economy. We have the gift of huge, effervescent real GDP with huge, ginormous inflation. And that is shifting, and you see it in the headlines from Walmart and Target.
And Tom, I'm confused here. We've missed on revenue, or rather, revenue is decent. We've missed on profit. This is a margin story right now.
Oh, yeah, it's a margin story right now, but they can fix that. I mean, that's what people do. I'm going to say this, John, and our next guest will be malleable about this as well. They're malleable. They can adjust.
Tom, wasn't that the story last year? They did adjust.
I think that's
they
more
put prices
now.
up.
No, I think it's more now, John. You're going to see some brutal decisions made. Everybody's quiescent about this. I think you're going to see, and Hatsias yesterday at Goldman Sachs alluded to this, you're going to see some tough, you're going to see, John, October planning in May.
Yes, we're totally on the same page. Let's be very clear about this. Last year was about putting up prices.
Yeah.
The stomach what's happened with inflation.
This year's the cost
consumer
side.
could tolerate it.
Yeah.
This year's the cost side. TK, we're on exactly the same page.
Yeah.
The stock's down 13.6%. Problem is, though, Tom, for some of these companies, they believe that over time things may get back to where it was. Maybe they believe they don't have to make that cost decision just yet.
I think they're going to amend it, and they're also going to amend it based off a Fed, a central bank that's not going to be nearly as hawkish as the zeitgeist that's out there right now. Futures -9, John, all of a sudden -14 off that bout of headlines.
As the world starts to look a little more like Walmart, Target, Lisa, one data point, here's your second.
So the other question, though, is how much does this have to do with the change in what people are buying? They're not buying the higher margin items. They're buying food. How much is this a specific story versus, exactly to your point, a broader one that's going to really test the resilience of consumers to higher prices still?
Product mix. Lisa, that's exactly what Walmart was discussing yesterday, and it sounds like what you're talking about too. Tom, Target down by more than 13%.
Yeah.
And it's actually been pretty resilient through the year so far, year to date. The stock has anyway. It's not this morning.
We've got the famous surveillance Rolodexes, folks, and there's one, it's a big turning thing, and it's been there, done that, is what we call the Rolex. Andrew Slimman joining us now, Senior Portfolio Manager at Morgan Stanley, in charge of the been there, done that division. Andrew, you and I have seen this. First you try to raise prices, and then there's a meeting on the 14th floor where you say, we're going to cut costs, and we're not waiting for October and year-end planning. Is that what we're going to see in this quarter?
Well, I think what we're seeing this quarter is the consumers pushing back. They're saying you can't raise prices, and so you're seeing a classic margin squeeze. And so enough, it could be a situation where the consumer is saying no more inflation. I'm not going to pay the higher prices, and exactly what Lisa said, they're grading down. So this is classic pushback on the inflationary pressures. Unfortunately, costs are still going up. So you're seeing the earnings misses are starting to come in.
So, Andrew, what does this say about earnings potential this year in America?
Well, so far, I mean, look, so far we haven't seen it. We haven't seen the fall off. I think there will be, earnings cuts. The only question that you have to ask yourself is if stocks are down, many stocks are down 20 to 30%, do they reflect some earnings cuts? And, to the extent that if stocks are down today that miss, well, they're not down enough. And so I think that's the key question is how much are they going to miss, and are they already reflecting that? And that gives me some optimism. I think it's too early yet, but it does give me some optimism on the market that maybe we won't see the magnitude of earnings cut that will be consistent with the amount of declines we've seen in some of these stocks. And certainly you're showing a stock today that's not the case.
Andrew, there's some perverse reasoning on Wall Street right now that if we start to see consumers push back, it's actually a good thing. It's a bad thing for these companies. It's a bad thing for margins, but it means that perhaps there is a natural slowing in inflation, a breaking point where inflation solves inflation. Are we getting to that point?
Yeah. I think, well, we're just getting to that part. But yes, I think that's exactly right. It's my view that inflation will peak at some point this summer. I think it's too early. And, you could see a scenario where the Fed does begin to slowly back off. I think that's the optimistic outlook. And this is a first sign. Today is a great example of consumers pushing back on higher prices. And so there's a great example, no better way to solve higher prices than, higher prices, hurting demand.
Andrew, how does this change your thesis, or how does this shape what you're going to be buying, where your convictions lie for the remainder of the year?
Well, I think what I said before is I think there are a lot of companies out there that are not necessarily going to see this margin squeeze, but their stocks are down a lot because they, say financials, some of these regional banks are saying their net interest margins are going up, and yet their stocks are down 30%. So my thesis really doesn't change, which is I think it's too late to run out and buy, uber defensive stocks. I am not sure we have seen the low for the year. I've been around this business long enough to know bad things usually happen in the summer. but we're certainly in that range. And then from a stock picking standpoint, I think you have to go find companies that you think have a good chance of delivering on their numbers, but their stocks are already down a lot. And that, that's a great game plan, and it's worked for me in previous, kind of 20% declines, and that's the game plan I'll, continue to pursue.
Let's just pause for a moment. We've got a $100 billion name down about 20% in the pre-market. On a story, Andrew, we've been discussing month after month after month for 12 months. For most of last year, corporations managed to adjust. To Tom's point, they raised prices, margins stayed healthy. In many places, margins improved. I find it really difficult to believe that this margin story begins and ends with two companies, Walmart, Target. Andrew, we've been talking about this happening for a long, long time. This feels like the start of it. And we may have seen peak inflation. Fine, whatever. But if we plateau at 4%, 5%, and these guys can't pass on higher costs, we've got an earnings problem on Wall Street, don't we?
Yeah, and you've got a PE compression problem. Stocks don't go up when inflation's running north of 4%. It's just, historically that's the case. So yeah, I think it's a tough, situation. And I don't think the market this year is going to put in a great year. But again, let's just make sure we take a step back and say, well, 38.50, that's down, that's down a lot from where we started the year. So I just want to temper that because, again, I see a lot of destruction in stock prices already. Clearly not today, the one you're showing, but I do, yesterday the home improvement stocks, they were down a lot. And so, the surprises weren't as, negatively perceived. So you really need, it's a real stock picking, situation, and what companies can pass on the cost, clearly not the retailers, and how much are their stocks down.
Andrew, awesome to get your view, buddy. Great timing this morning, too. Andrew Sliman there of Morgan Stanley Investment Management. This name's still falling, Tom. We're down 22% in early trading.
Yeah, it's a big movement back, and we got to remind ourselves, John, this was roughly $115, $120 per share in the beginning of the pandemic. Target with a moonshot up to 253, and it's given that back, as you mentioned, John, 170, even a 168 moments ago. I think we need to put in perspective the glide path of these companies before Valentine's Day of 2020 and afterwards. I think that perspective is really going to be important company to company.
Elisa, what a move lower in the pre-market.
Honestly, and again, to that point that you were talking about with Andrew Sliman, that basically the fact that we've already priced in some pain and then a downside surprise could yield this kind of move in such a big name shows you the potential risk out there, the potholes as people reassess, and frankly, the binary outcomes. Either they can withstand this inflationary pressure or they can't, and these names seem to suggest they're going to struggle a bit.
It's tremendously difficult to execute in this environment. Yeah. Everyone's finding it very, very hard. I am surprised that there is some surprise here. I'm struggling with this one. I don't want to beat up on the analyst community, Lisa, but to miss like this, to see the stock down like this in the world that we've been talking about for a year now.
Yeah, well,
it's kind of surprising.
I wonder how much
it's surprising.
It is surprising that it's surprising. However, how much is this tied to food and things that really came out in ways that people were not expecting in terms of the pace of inflation?
The product mix is clearly shifting at a lot of these companies. We're down 21% on Target. Futures are lower too by 0.4% on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. U.S. futures are slipping today after those hawkish comments from Federal Reserve Chair Jerome Powell. Powell told a Wall Street Journal live event the Fed will keep raising rates until there's clear and convincing evidence that inflation is falling. He also said the economy is strong enough to withstand tightening. The Biden administration is set to bring Russia closer to the brink of default. Bloomberg's learned the Treasury Department will move to fully block Moscow's ability to pay U.S. bondholders next week. The U.S. had issued a temporary waiver that let Russia pay its coupons. The waiver expires May the 25th. And the EU is considering whether to use proceeds seized from Russian oligarchs to help rebuild Ukraine. The EU also will propose issuing joint debt. Ukraine's Foreign Minister Dmytro Kuleba told his European counterparts that the reconstruction bill could reach $1.1 trillion. And new COVID outbreaks in China raise the risk of more disruptive restrictions. Beijing reported an increase in infections On Tuesday, a cluster also is ballooning in the Sichuan province. All this is happening as Shanghai slowly emerges from that 6-week lockdown. The Justice Department has sued billionaire casino mogul Steve Wynn to force him to register as an agent of China. The suit argues that the former CEO of Wynn Resorts used his relationship with President Trump and members of his administration to advance Beijing's interests in 2017. Wynn's lawyers say he has never acted as an agent of the Chinese government. Global News 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?